fiscal profile, because that will lead to lower interest expenses. Right now, people are looking at the fact that there is no leader in the House and attributing part of the move in the Treasury market to that, saying that dysfunction in Congress is allowing yields to keep climbing as the fiscal profile of this nation gets called into question. How important is it to you to make sure that there is at least a functioning, at least a cross discussion among representatives?
Yeah, we have to have that. And look, I believe a number of my colleagues, some of them were chasing cameras, others of them had actual policy issues. And they erroneously, in my opinion, thought they would be able to move this process along more effectively and faster by shutting down the government. My experience both in 2013 with the Obama administration, 2018 going into 2019 with the Trump administration, that isn't the case. So that was bad tactics on that part. But how do we restore confidence? That's a key thing. We've got to get unified and quit the circular firing squad in the House of Representatives. But we do have long-term issues that we have to address. I have a bill that would call for a debt commission, a fiscal commission that is going to look at all of the various trust funds. It would be something that couldn't be amended. It would be forced to be have a vote taken both in the House and the Senate, and it allows us to address that 70% of all the federal spending that happens on autopilot. I don't touch it as a member of the House. The senators don't touch it. The White House doesn't do anything with it. It's just on autopilot. And if we don't wrestle that dragon down to the ground and have an open and honest conversation with the American people, then we're going to be in real trouble if we see any of those bond rates continue to go up, because we're knocking on the door of $800 billion in interest alone right now.
Congressman, how much of an obstacle is the former President Trump to getting some sort of real discussion like this put forward, considering the fact that he was one of the people pushing for a shutdown, pushing for basically just make it not happen. Don't pay the bills until you get what you want.
Yeah, well, it's not helpful at the end of the day. Like I said, I think that is that's an erroneous strategy. It doesn't work. Getting back though to that long-term issue, you know, both President Biden and President Trump had said you can't look at some of those massive drivers of our automatic spending. That's a mistake as well. And I'm glad to see we've actually had this bipartisan bill. It was 7 Republicans, 7 Democrats who were the original co-sponsors of me as author to set up this commission. You know, and that ultimately doesn't matter what the politics is trying to dictate out there on either side of the aisle. The realities are what we have to deal with here as policy makers, and I hope my colleagues will step up and actually be policy makers and honest brokers.
Congressman, thanks for your insight this morning, your perspective. Thank you, sir. Congressman Bill Huizenga there of Michigan. TK, your thoughts?
My thoughts is he's a small businessman in Congress. There's not enough of these. This is a guy that actually ran a successful business. How odd, John? How strange.
Be nice to get his thoughts on.
It's a really different thing.
On where he stands on those current strikes in his state as well.
Yeah, the strikes. He's a bit distant from that. This is over in western Michigan. When you fly over, you go into O'Hare. This is that hunk of land you see before Lake Michigan. But, you know, the bottom line is this is part of the Republican Party that's been completely overwhelmed by what we've seen from the former president, from Mr. Gates in his conversation with Balance of Power last night. You know, this is the 96% Newt Gingrich is talking about.
What did he say? If you're in glass senates, don't throw stones or something like that?
Yeah, that was the, you know, a shot at the senator from Connecticut.
That's a decent line. You would expect that. All very friendly, diplomatic, on the edge of English. Bit of share of Academy
Almost
Securities.
British.
Almost coming up. Although they shout at each other sometimes, which is a little bit too much, but you know, whatever.
Yeah, it's physical over there. I think we'd do better.
We would do better. Physical.
We would do better if the House of Representatives had the physicality of the House of Commons, where they really go at it.
You want to see more of that?
I'd like to see more of that.
You're alone. I'd actually like to see the president a little bit more engaged as well.
Same thing.
But, you know, that's not happening anytime soon. Equities just about unchanged on the S&P 500. As I said, Peter Cheer of Academy coming up a little bit later. On the bond market, fixed income right now, really the epicenter of our world. Yields lower by a couple of basis points. The 10-year 471.65. Jobless claims just around the corner in the next hour, 34 minutes away, with equities going absolutely nowhere. From New York, this is Bloomberg.
From the world of politics.
We're not going to be relying
upon countries whose values we don't share.
To the world of business.
It's all about corporate power in the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee
The
Langs.
door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
That
it.
really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come. I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers
Right.
that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
These negative things that we're talking about, they're right in front of us.
There's really no guarantee that Treasury rates have peaked or are about to go lower.
I think the wake-up call is coming. We're starting to see that in liquidity of credit. It's starting to deteriorate and spreads are widening.
What I worry about is if this sell-off ends up being sustainable.
There's a bar at which the Fed would come in and do something to stabilize markets. That bar is higher because you have this backdrop of inflation.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television. Quite a day. It's a calmer day, says John Farrow. I don't buy it for a moment. I look at the screen and I see some real history being made. We've talked about it all morning, John. And the important thing is the conversation forward from Fed officials, and I'm going to suggest also from bank managements enjoying this move in the market.
What a different a day makes. Hey, do you want to sing that?
Or 2 days.
Do you want to sing that?
No, I can't sing.
We'll
It's
give that a
Lisa.
miss.
Lisa
What a
does.
difference an ADP report makes. A downside surprise sparking a big bond market rally. So look at the data. Jobless claims coming in 29 minutes time. Payrolls tomorrow morning. And I think we know the game plan now, Tom. We know what regime we're in. Bad news, slightly bad news, is good news, apparently, because Treasury starts to rally and equities get some relief. We'll see if that sticks.
You get a Hail Mary recovery here in bonds, price up, yield down. Maybe some of the angst goes away, but in those conversations to open this hour and what we've heard today, I thought Kelsey Barrow of JP Morgan was just lights out moments ago about what if we don't get...
She was fantastic.
Price up, yield down. What are we doing in November?
She's looking for a rally at the long end. Perhaps this Fed's going too far in their mind. Lots of Fed speak today. Lisa's going to catch up with Mary Daly of the San Francisco Fed. Really looking forward to that. You'll hear from Mester, Kashkari, Barkin and Barr tomorrow. You'll hear from Waller. This from Andrew Hollenhorst, the City. TK, Fed officials won't push back on higher Treasury yields. Are they embracing what we see? Goolsby of Chicago says he's puzzled by it. To Joe Weisenthal and Tracy Alloway on the Odd Lots podcast. I have to admit, I'm struggling to see why he's puzzled by some of it.
To me, it's an
There's
academic
a lot of reasons
phrase,
for it.
It's not in his theory books at University of Chicago. But Lisa, what's important here, when I say some mathiness like log convexity, that's a drift function that's under control. In the last 4 days or so, your world has not been under control.
Which I think was interesting that Kelsey Barrow nodded to. And she said, you know, at some point it felt like there was another freight train getting involved that they didn't necessarily want to dive into, and that was where the buyer strike comes into play. What that freight train is, though, has yet to be identified. That maybe speaks somewhat to the puzzle. Yeah. Because if you look at, is it a buyer strike that has a more permanent structural kind of implication, or is this sort of a short-term, even the buyers don't want to get in the way of something that is essentially a falling knife until you get catharsis?
For Global Wall Street, we're going to do this quickly here because our next guest is too important. And for those of you that are not part of Global Wall Street, we're going to try to speak in English so you can understand the tension out there. Think 7.88%, 30-year mortgage, John, 2 days in a row.
Equities just about positive. Let's whip through the price action, Tom. The S&P 500 just turning positive moments ago. Yield to lower by a couple of basis points, 471, after thinking about 490 on a 10-year. Only at 1 point yesterday in the Asian trading session, all the way back down again. We're down by a couple of basis points this morning on a 10-year maturity. On a 2-year, down to 5.02%. So rates were a problem, Tom. Treasuries have started to rally. The dollar was dominant, starting to weaken just a touch against the euro 105. And crude had absolutely exploded higher from the summer and is pulling all the way back down to the low 80s.
I'm sorry, I missed that.
Gasoline demand yesterday, latest figures showed some weakness there.
Yeah.
We were worried about stockpiles, inventories. Maybe they're starting to build again. So a reversal of recent trends. We'll see if that sticks, Tom. One data point, maybe a couple. Yeah. But that's the news.
We're going to dive into this now. We're going to do a nerd fest here. And John and Lisa got some smart questions on where we are right now. Joining us, hugely qualified, Peter Shear, head of macro strategy, Academy Securities. He's enjoyed these kind of moves before. Bank of America, before they blew it up. Bob Sinch in foreign exchange, really experienced, and a guy riding a herd, a guy named David Goldman, who was in my book. David Goldman told me once, look at the tranches, and you nail this in your note, and everybody's looking at worry, distress, South African Rand, blah, blah, blah. And the David Goldman tranche is the quality stuff up here. You write about previously deemed safe assets. How close are we to those better tranches of credit being previously deemed safe assets?
Yeah, and I've always looked at this world of, you've got high yield and IG, and Treasury's always been that safe asset, super safe, and it feels like something's cracking. I think this time we're going to be okay. I think we're going to get the 10-year back below 440 because we're going to see kind of a really quick gap lower in yields as data comes out weak, but I do think something is cracked, and for the first time in my lifetime, people are actually questioning the trajectory of where treasuries are going to be, and that is very concerning to me because every financial bubble that we've ever had has always come when it's a safe asset that breaks. It's never the risky assets, it's when a safe asset breaks, and we had a whiff of that in the past kind of week or two.
There was a test yesterday, though, and I think the test is always for developed markets. When bad things happen, do we buy treasuries? Something negative happened. We got a soft ADP report for whatever that's worth. We bought treasuries. Isn't that a decent stress test just to understand that if things do go south in the economy, this still works?
I think there's a lot of ebbs and flows. So everyone got so bearish on treasuries. People were piling into it. People had tried to buy treasuries. I've liked them since 425. I liked that 440. So people were very reluctant. So we finally had a bit of that capitulation trade right now. I think as weak data comes out, we're going to see treasury yields go lower. And then we're going to get back to thinking, okay, what is really the long-term trade? And I think that's probably now higher yields.
You think there's a limit to how much bonds can rally, yields can fall on negative data?
I think right now, yes. I think this overlying fear that DC no longer cares about our debt trajectory is problematic. I think if you look at the U.S. as a creditor, we don't seem to care about the debt. We don't seem to even necessarily want to pay the debt. There's all these kind of weird messages coming out of DC, and I think that's going to weigh on the market.
When you said that the longer-term trade is higher yields, how much higher, right? I mean, what are we talking about at a time when you say that something has cracked, that the sell-off that we've seen so far has something sort of damaging inherent in it?
So I think you're right when we were talking about no one could figure out why we kept moving wider every day, right? Yields kept going higher and higher. So there were, I think, a lot of things at motion. You have China no longer buying treasuries. I think you've got our supply issue. The only thing I think that is really going to prevent treasuries from next year breaking about 5% or higher is DC kind of getting its act together, starting to put forward budgets, starting to put forward something that resembles, fiscal responsibility. If we don't get that, I think people are losing faith in that, and that's really problematic.
But when you say that basically we're going to get a drift lower, and then when people start to understand that, they're going to go higher again, doesn't there sort of a self-limiting feature to this? You said, something cracked in terms of where we were going, the speed we were moving. Aren't we going to get some sort of bigger financial accident, like everyone's been saying, if we lead to, yields of 5% on the 10-year on a persistent basis?
I don't think we get a financial accident necessarily. It depends on how rapid it is. So one, I think we get back to that 440. I don't think we get back to 4% because, like you say, we've had this experience. I think it's a 6 month to a year-long experiment where we start seeing what happens with the election, what the trajectory of the debt is. If people lose faith in that, then I think you go rapidly above 550, you start testing that, and that's where you get the forced selling. The reason I'm always concerned about safe assets is twofold. One, people own them in huge size in their portfolios because they were never worried about losses. If you start worrying about losses, that causes forced selling. And the other part is, what does the banking system own a lot of? And if the banking system, which is always levered, owns a lot of treasuries, and you see this never-ending push to yields higher, I think you see some forced selling and risk management there. So I don't think we're there yet, but I think that's the trigger that we've kind of got just a sniff of this time around. And go back even with housing, right? We had housing bubble, it's broke a little bit in early 2007, late 2007. The ultimate problem didn't hit until 2008.
But Pete, you're making me want to just go and hide under a rock. What on earth do I own, if that's your outlook?
So for now, I'm actually bullish, bizarrely enough, right? I do think we're going to get this weak economic data. I think oil was way overdone. I think we're going to get this relief trade. Okay, there's not this inflation pressure. Yields start drifting back to 440. We send stocks higher. Everyone's underweight again. So we have to suck out that kind of pessimism. Then once everyone gets bullish again, then I can get really bearish in positioning.
Okay, wait, but what are you talking about? Are you basically saying that there is a bubble in treasuries that's going to burst with catastrophic implications, to build on what John was talking about?
I don't know if it will or not, but that's all of a sudden became awareness of everyone. And DC can fix this, right? DC can get its act together. I just think everyone's kind of grimacing because no one really believes DC is going to get its act together. But I think that's really the hope, is something comes through and DC starts going back to the days where you run a budget deficit when times are tough, but when times are good, you try and cut it back.
Let's finish here. What does this mean for portfolio construction? A lot of people listening might sit down with a financial advisor and they give them the same old spiel. What we're going to do is split up this portfolio 60-40, and they're going to go on to explain why. Doesn't that all go out the window?
I think you have to be very careful, and you're looking for constantly risk management, right? What looks overdone, what doesn't look overdone. The 2-year seems safe, but I think there's no value in the 2-year. At 490, there was a lot of value in the 10-year. I think down at 440, you want to expose that. But as your yields start shrinking and getting to these narrow ends of the range, take some off, take some bets there. I think you want to expose yourself to equity risk right now. You really start making sure those exposures, where do you want to be in the world? And I think outside the U.S. could be interesting. Continue to look at emerging markets. I think you see a lot of trends there that are beneficial for emerging markets over U.S.
There is acclaimed, and he wrote a great one volume on financial history, Chris Wayland, our Christopher Wayland. And he had a note last night which goes to the heart of the bid walking away in fixed income. It's the Wayland silence. And that is, you've got a piece to sell, and you get on the phone, and there's nobody on the other side of the transaction. How close are we to the Wayland silence?
I think we had, again, whiffs of that, right? The Treasury market,
perfect.
And that's all we've had so far. And I think, though, across all assets, you look at what's going on with oil. We've gone to this electronic algo-driven trading, so I think there's this perception of liquidity, and there's no depth of liquidity. So the ability for markets to move very quickly is very high because we have this fake or faux liquidity where everyone's scrambling around trying to make their penny or eighth of a point, and the reality is big moves push us very quickly.
Bottle it.
Clinic, a big what if, a lot of worries for for a lot of people who might be listening to some of this, Peter, but ultimately buy risk in the short term, right?
Buy risk in the short term.
Load the boat.
But I would say this does remind me a bit when I was trading the credit derivative indices back in 2007, where you would just gap. You would go from 60 basis points to 68 basis points, no UI, and then you look and you trade it around 68. And that's the sort of moves I think we've been getting in these markets, whether it's oil, whether it's trades. You get these gap moves, you air pocket, everyone tries to make some semblance of it. But
is
it's
this one-day option thing, is that the new portfolio insurance?
You know, people are definitely pushing on that, and I think it's the opposite of portfolio insurance. I think it's used heavily to drive markets, push gamma trades, and I think everyone forgets that it can be used on the downside just as easily as it is in the upside. This isn't like some of the other trades, which were bullish only, like we saw with the ape stocks. This is really the ability to push direction, and I think they can lean on markets down as easily as up.
Pete, this was great. Always walk away from our conversations with tons to think about. Peter Cheer of Academy Securities. If you are just joining us, welcome to the program. The S&P 500 almost totally unchanged on the S&P. We're negative here by 0.02%. Coming up a little bit later, Mark Giannone of Barclays reacting to the jobless claims data. That claims data has been rock solid. The previous read was 204,000. The estimate this morning, Bramo, 210. I believe the 4-week average is the lowest since February. It's been pretty impressive, that labour market. And the one thing that stands out, I think, in the last week, because otherwise the data was pretty decent, I don't buy into the idea that services was weak. I know there was some sub-indices that were a little bit softer, but overall...
Future orders.
Still in the 50s, aren't we? Still doing okay.
And it still came in higher than expected. Yes, it's decelerating, but not as much and as quickly as people were previously saying, at least in a headline figure. I am wondering, I'm just trying to wrap my head around what some of the things that Peter Scheer was talking about with respect to a potential bubble in the safest assets. What if the real economy doesn't ever notice? What if it basically corrects itself quickly enough that the lag effects never take effect? I mean, this is sort of what people have been betting on. This is how unused to the environment that we're in right now people are.
After listening to Pete, I still can't decide if I should buy stocks or hide. It's like one or the other.
When he and I used to have conversations back in the day, we might as well have just been sitting on,
I can only imagine.
It's like, oh no, gloom, doom.
We should find those old IBs of you two just winding each other up.
It was really fun.
Kevin Tyner of Bloomberg Intelligence joining us very shortly from New York City, your equity market. Just about negative on the S&P. No real drama here. Tons of drama in this bond market over the last month or so. 471.85 on a 10-year. Yields lower by a single basis point. Jobless claims about 20 minutes away.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
All All eyes turn to the U.S. job market.
The jobs report, it beckons.
It looks like companies are just holding on to workers.
What you see is what you get. We're seeing a lot of strength.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
This is exactly what the Fed is looking for.
They now believe you can get back to 2% without damaging the labor market at all.
We might get a bigger whammy than we expected.
The September Jobs Report, Friday on Bloomberg Television and Radio.
They've been spooked over the last week or so by declines of 2, 3, 4, 5% in their ETFs, and so I think they're joining the crowd in terms of selling, and we're seeing a little bit of an oversold market here, headed to 5%.
A man who has seen it all, Bill Gross, the PIMCO co-founder, speaking with Katie Greifeld and Romain Bostic on a close yesterday, talking about a bond market that's seen some big moves, treasuries aggressively lower, the yield's much, much higher. We back away from those levels this morning. We look like this. A 10-year yield down a single basis point, 471.85. The 30-year did breach that 5% level yesterday. It's come all the way back down, Tom. Your 30-year right now, 486. I think you can call that 487.
Yeah, we're watching it. I mean, the 2-10 spread hasn't given up disinversion. I expected it to be down 1 or 2 basis points, and there's not. You're right, it's calmer, John, but it's not a correlated calmer. It's not a confirming calmer. Maybe we see that with good data here, in 12 minutes?
Claims and then payrolls, the big one tomorrow.
So we'll see. We're going to keep you abreast of that, folks, and try to give you the best conversation we can. Kevin Tynan joined us here. What's important about our senior automobiles analyst for Bloomberg Intelligence, and he's kept count. He's got a wood mark in his garage, folks, of the number of times he's put the screw down the Chrysler distributor when he's changing the plugs. Kevin Tynan, the real thing in the auto. Kevin, I've been dying to ask you, and it's in the zeitgeist, when are we done buying $100,000 EV vehicles that weigh the size of a Hummer H2? When does that party end?
I think very soon. Well, I looked at it, and look, the production launch and the new EVs coming out are set through 2024 and probably beyond. But I think what you're going to get as an inflection point is if you don't, or if the automakers don't start to see real demand and real profitability in that drivetrain type, I think you're going to start to see by 2025, 26, and plans beyond that start to shift to something a little bit more practical. And we've been saying that might be the plug-in hybrid makes a reemergence, with battery technology. Maybe that's a 50 to 100-mile range in electric with the, range extending internal combustion or hybrid engine on top of it. So you're talking about 400 miles of range without the anxiety of where to charge or this charging infrastructure that isn't quite ready.
I got 8 more questions on this, but I believe Lisa, help me here. There's a strike still going on?
Yes.
It's just been buried by the news. I mean, there's no other way to put it. What's the new on the UAW strike?
Yeah, look, from my view, I think what you're going to get is a big number for the UAW, but not a whole lot else. And I think that's probably what the issues are. The automakers can't hide their profitability over the past 10 years, and this mix shift to truck from car has been very profitable for them, and everybody sees it, right? But at the same time, they've done that with fewer units. So I think on the one hand, the manufacturers are saying, okay, we can give you a share of those profits, but we can't guarantee that we're going to be growing in size. And I think what a big number does, whether it's a 30% or somewhere in that ballpark, what it does, it also enables the union to go and show that contract to some of the non-union, whether it's pure play EV manufacturers or transplants in the U.S. that are operating with non-union labor, to say, look what we did for our membership. Because at the end of the day, if the UAW wants to increase its member base, they can't keep going back to GM, Ford, and Stellantis. They're not growing in that way, right? So if this is about increasing your membership for the UAW, you're going to have to go knock on some other doors. And I think a backhanded way that the legacy automakers, the domestic Ford, GM, and Stellantis brands can do it is to say, here's your big number, but we got to have the flexibility to get out of some capacity going forward. But go show this to some of those other plants and see what they say.
Kevin, we're getting some sense from the auto manufacturers of just how much the strikes have been costing them. General Motors came out yesterday and said it already has cost them about $200 million since the strike began. We've heard from Ford talking about the F-150 deliveries and how much they've been plunging on the heels of a number of shuttering factories. I'm just wondering at what point we can expect this to precede price rises in some of the cars that they deliver, with the justification that really they've got to compensate for these costs.
Yeah, and look, that production is not necessarily all lost. It'll shift to the next quarter or into 2024, but it's exactly that. And this is what we've seen. And it didn't really start just with production disruptions during the pandemic. You know, the automakers have been moving to this smaller model, more trucks, higher transaction prices, fewer units. So it isn't so much about scale anymore. And this is another part of that, where there's inventory on the ground, probably not quite enough, but ultimately all it does is firm up prices, and the increased cost, although maybe the labor portion of cost of goods going forward is minimal after the contract, but at the end of the day, it's going to remove affordability from the consumer, right? Because automakers are going to have to continue to keep supply and demand tight and move up market to be profitable on the operation. So that's really going to hurt the consumer at the end of the day.
Kevin, I was reading about BYD, which is becoming the biggest electric vehicle maker in China, and I was reading about how they grew up out of first imitating Toyota and then becoming so efficient that even Toyota was trying to understand exactly how they were doing it. How does the U.S. compete with China, all things being equal, without tariffs, without some other guards between the two industries, if there's a very different playing field?
Yeah, it's going to be very difficult. Look, though, the macroeconomic, the government influence varies region by region. So the subsidies that you had in BYD, back in the day, that's a company that was, direct subsidy from the government was well over $1 billion, probably over $40,000 per vehicle. We won't do that here. It'll be difficult to keep them out. And the other thing I think that's going to happen is if we're going to get a rush of Chinese-built EVs in this country, they're going to go directly to the dealer network, where we have this sort of perception now that the direct sales model, what Tesla does or Rivian and Lucid, is the way to go. I think those companies are going to achieve immediate distribution scale by going to the dealer base and saying, like, will you sell our product, as opposed to trying to deliver it directly to the consumer, which, has issues with when you get paid for those vehicles, right? You can't book that revenue till you deliver them, but if you deliver them to the dealership, you can, right? So your gross margin stays firm, and you have instant scale in terms of distribution. So it could happen very quickly, although there's still a lot of hurdles to get over for really China small manufacturers or EV manufacturers to get into this country.
Hey, Kevin, just to wrap things up, I know we touched on this briefly, but what are the odds that some of these manufacturers just don't get this transition done? They look into the future and they throw in the towel and say, this isn't going to happen.
Yeah, and look, I don't know that's not a binary bet of bankruptcy or not bankruptcy, or you exist or you don't exist.
Oh, absolutely.
There's certainly a scenario where, legacy automakers or global automakers leave that drivetrain business to the niche manufacturers, to Tesla, and it's a smaller part of the market, certainly here, but maybe in other countries. And what you can get is to say, like, and Toyota's been saying this the whole time, is like, there needs to be options, right? So internal combustion will work in some regions or for some people, so will plug-in hybrids, so will gas hybrids, so will electric. Maybe hydrogen is an option too. So I think that if it's about climate, right, there needs to be options. If it's about capitalism, that gets a little
precisely.
bit...
Kevin, you know where I'm going with this. If it's about climate, it's not about massive SUVs that just happen to be electric. Let's face it.
So it's not about climate.
Precisely. Kevin Steiner, thank you, sir, of Bloomberg Intelligence. If it was about climate, it wouldn't be about that at all, would it?
Right.
You can't conflate the two things.
You know where I am on this.
We're both on the same page.
And Lisa mentioned this, John, and this goes to the United Kingdom. A headline: BYD ADL to supply 130 electric buses for Coventry. It's just as simple as this. China's out front. We're playing catch-up.
Big time. Next hour, Joanne Feeney of Advisors Capital Management, Chris Mamani of Lafayette, and on the bond market, don't miss this. Next hour, Mark Kiesel, PIMCO, coming right up.
the EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
Bloomberg surveillance, Lisa Abramos looking at the bid on bonds. I guess it's stable. Here we are seconds before this economic data, Lisa. What do you think? Bonds up? Price up? Yield down?
If there is a disappointment, say an increase in jobless claims, that is the expectation that there will be some sort of firming up of the bid. But how big does that surprise have to be, Tom? And that, I think, is what we're going to see.
It's a thin set of data today, but an important set. Trade balance, ancient data. McKee will discuss that, but clearly everyone claiming to focus on claims. Michael McKee, thumb up, thumb down for bonds.
I guess at this point it would be thumbs down for bonds because the numbers don't really move that much. 207,000 jobless claims filed last week. This is not what we were really expecting. We thought the auto workers might start to show up in these numbers. 204,000 was the initially reported number in the prior week. The continuing claims numbers also lower, at least compared with the previous issue, 1,664,000 compared to 1,670,000. So it's kind of interesting to see that what we're getting here is a still tight labor market, even though we've got people on strike who make other people eligible for jobless claims when we thought they'd go up. That didn't really happen. Tom, you mentioned trade. Trade balance comes in lower than it had been expected and lower than it was the prior month, 58.3 billion, down from 64.7, and that is going to be something that contributes to third quarter growth as well. These are August numbers. So now the revisions are in for jobless claims, only up 1,000 last week to 205. So 207 is hardly any change at all. And it looks at this point like the labor market's not getting a break, and your bond trader friends are not.
We're going to do a bond trader Bramo data check here. Really, really important. Equity's a little bit south, but Lisa, I went right to the 10-year real yield, 2.41%. Not out to new highs in the inflation-adjusted yield, but, teen-sweets away. This is something. Am I right? Price down, yield up? Is this a good generalization?
I mean, we are moving up just a couple of basis points, 4.74 now on the 10-year yields. And we're watching this across the yield curve. And it goes to a guest earlier in the show that the entire yield curve is moving in tandem as people try to reset to understand what the new normal is. But I will say, these are incremental data shifts relative to what we were expecting. The fact that we're seeing movement on this at all gives you a sense of just how jumpy everybody is trying to understand where the economy is, what narrative is going to prevail, and what exactly is driving the bond market.
I mean, here we are, and I guess it's not as a break point, but as John mentioned throughout the entire morning, it's been a calming in the market. Is this data that will uncalm Fed speakers, Mike McKee?
I don't think so. The Fed
Are they going to stay puzzled like Goolsby?
Well, remember, the Fed has expected unemployment to come down from its initial forecast, or its June forecast in the September SEP. So they're not going to be surprised. And the story would seem to be, if the bond market wants to propose a recession is imminent, that people want to hold on to workers. And that's the story that we have been seeing, these labor hoarding numbers. We did see Michigan and Ohio jobless claims rise among the largest increases with over 1,000 each, but that's not a whole lot.
Just question, though, on ADP, because a lot of people dismiss it as irrelevant as soon as it comes out and moves markets. I am curious whether people have changed their expectations for tomorrow's print based on what we've seen from ADP.
Well, this is kind of fascinating. The ADP number would suggest perhaps a weak number because they have come in above the private sector hiring for the last 5 months, but the whisper number has gone up. The Bloomberg survey sees 170,000 jobs created, and the whisper number is 180 at this point. So the market seems to think we're going to get a stronger than expected number.
You going to be with us tomorrow? You're not going out
if
to
you'd like.
Broncos?
I mean, I don't know. Jobs Day is usually kind of slow.
It's the Super Bowl
in the markets. Yeah.
It's a Super Bowl. Michael McKee with us tomorrow for the Jobs Day Super Bowl. Looking forward to that. We'll go beneath the headline data at 8:30. There is a book. It is 800 plus pages. Everyone owns it. No one's ever read it, I should say, except he lived it. Michael Woodford, 20 years ago, in 2003, wrote a definitive book called Interest in Prices. Mark Giannini of Barclays, their chief U.S. economist, had the toughest job in academics. He was the assistant to Michael Woodford. You had to actually read Interest in Prices, right?
Yes, I did.
You had to teach Interest in Prices.
As well, yeah.
Is this economy, are these dynamics identified by the Euler functions, the classic Woodford advanced mathematics, the dynamics of that classic textbook, is any of this economy in that textbook?
I think a lot. I think this textbook and the model that it develops there is really central to understanding what's going on in the economy.
In what way is it right now?
I think it's a lot of what's affecting the economy and the way monetary policy affects the economy in particular is through the communication, through what the Fed is intending to do in the future. I think this book in particular develops a whole theory, a full understanding of how communication, how the forward guidance that the Federal Reserve puts out is transmitted through the bond markets, through the longer-term rates, and how it's transmitted as well through the economy.
Just because of time, and I've got to go just simply to this, and the word optimal, folks, figures into this thinking, is critical. What is the optimal Fed communication strategy now to get to a constructive outcome?
I think optimal policy would be one where policy is indicating really a tight policy stance until it's absolutely clear that we are returning to a 2% inflation target.
So just to build then on what Kelsey Barrow was saying, she said that we are going to have a hard landing and the Fed will be the last to admit it. Is that what you're saying as well, that essentially the Fed's going to need to see a hard landing in order to come in and actually make a shift?
I think the Fed is going to be slow in cutting rate. I think they have indicated really clearly that they want to maintain rates elevated for a long time, to be really clear, really sure and confident that inflation is returning back to the 2% target. So I think a mild slowdown in the economy might not lead them, as they have in the past, to really cut rates abruptly. Now, if we have a very hard, landing or really a deep recession, then of course they would respond to that.
How much more likely, in your view, is a hard landing or a more punitive recession, given where we've seen yields go, given the long end and how much we've seen that move?
Yeah. So I think there's a huge amount of momentum in the economy, and we've seen the latest data on consumption, on initial claims this morning again, showing really the labor market is tight, consumer is really, really strong, and that provides still a lot of momentum to demand in the economy. With yields moving up as they have in recent weeks, I think that's pressing on the brakes, that's slowing down the economy. But this is coming in tandem with stronger data as well. So I don't expect at this point really a hard landing. We expect really a bumpy landing, so we are a little more pessimistic at Barclays than the Fed is for next year, but not a deep recession.
You took Woodford's book. Olivier Blanchard, when he reviewed the book, he called it an immediate classic. He went back to pre-World War II and Patinkin and said that the idea, the intellectual lift here was profound. All that's great, except Blanchard wrote in my book of the summer, a small monograph on fiscal policy and its link into economics. Olivier wrote that there's other factors out there. Do you at Barclays see other factors like technology, whole different sets of international systems that make traditional economics non-operative?
So I think from a conceptual standpoint, I don't think things have changed dramatically. I think from the reality in which we are, the factors have changed. So the technology, of course, shows some promises. It's yet to be seen when it's going to show up in higher productivity numbers. I don't think we're seeing that yet, and it's probably going to take a long time until we see that.
Right, when you start sweating, as you did at the Swiss National Bank years ago, you dial 1-800-AJ Rajadox. You've got a bond genius at Barclays and AJ Rajadox. What do you and he think about price down in we moved from a log convexity, a stable drift function, to a free fall in bonds in the last number of days? How do you and AJ fold that in together?
So I think with AJ, with our rate strategist, and Schulpert, and we're talking a lot about the stance of policy and the expectation that the Fed is going to remain tight for some time in 2024. We don't expect any rate cuts, at least any time before September, and then we expect rates to over the longer term to not return back to the, in real terms, 0.5% that we had before. So something probably more elevated, closer to 1% longer term real rate. Add to that about 2% inflation, and you are easily at 3% nominal rate, 3.5% nominal rate. Add some term premium to that, and it looks like the 4.6 or 4.7% on yields is not necessarily stretched.
How much is this sustainable by the power that some people have said labor has gotten when it comes to negotiating wages? And I say this heading into tomorrow's jobs number after seeing that layoffs just aren't happening, even as you see these real pressures building on both sides.
Right, so I think the labor market is still tight, as I mentioned. I think the JOLTS data that we got earlier this week show that job openings are still very elevated. Over 9 million job opening. I think there is a lot of pressure on the part of the workers to raise wages, to push firms to accept higher wages. And we see our estimates of underlying wage growth is running at around like 4.3%, which we think is higher than what's consistent with a 2% inflation.
So in other words, do you see that 4.3% hourly wage gain to be something that we could see in perpetuity and that would lead to a higher inflation rate, or do you think that that's something that has to come down?
This is something that will come down as the Fed tries to bring inflation down, and in order to bring inflation down, we'll need to engineer some slowdown in the economy. So when that slowdown takes place, we'll see firms hiring fewer workers. We'll see this hiring rate come down, the job openings rate come down, and people will no longer be able to press for rapid wage rates.
Stay with us. This is too important a conversation. Lisa and I have to look at the markets moving here off of what we saw with the benevolent claims report. Lisa, up 3 basis points, a 10-year. Could we revisit 5% on the 30-year piece?
I mean, given how quickly and how volatile these markets have been, who knows? What I am seeing right now is a more material increase in yield priced down as people digest some of the data. The fact that we keep getting stronger than expected labor market data offsets some of the gloom and doom that people have regarding what higher yields can do to the economy longer term.
The VIX 18.84, not out near that 20 level of a number of hours, days ago, 2.43% on the 10-year, 2 basis points away from a new high on the real yield. The Standard & Poor's 500, negative 17 points, down 0.4%.
We're speaking with Mark Giannani of Barclays about the strength in the economy despite what we have experienced with respect to rates, which, Tom, to me, really raises this question, what is the breaking point, right? Can we engineer, and is this something that's sustainable despite the way that we've arranged the balance sheets in the face of
Ask it to Mary Daly at the Economic Club of New York, because that's right where I wanted to go. Mark, this is so important. Take the mathematics of modern science, Clarida, DSG, Gertler, what you did with Mark at Princeton and all the mumbo jumbo we've been talking about, bring it over to a standard Hicksian structure of the real economy. If we stay higher for longer, as you submit, what happens to the zombie companies developed over the last 16 years?
Well, a lot of companies will need to adjust to a reality of higher rates, and I guess that's they're going to try to stay in place for as long as they can, and at some point we'll see probably more failures. We'll see more restructuring taking place in the economy, and I would say that's a pretty standard transmission mechanism of monetary policy. When you keep rates higher and you try to slow demand, eventually the labor market cools and firms have to shrink.
And I lied to Mark. Now that I've lied to Michael. Now that you've been here, do I have to read interest and prices?
Of course.
All 880 pages?
Of course, all of them.
Go away. Dr. Giannini is with Barclays in Princeton, I should say, as well. Lisa, I'm sorry, we're talking fancy economics here. Nobody watching or listening is worried about 800 pages of Michael Woodford. They're looking at these markets.
They're looking at these markets and trying to understand how sustainable these are. If nothing breaks, is this the new normal? And then what does that mean in terms of what the capital structure is and the cost of it going forward?
2's10 spread under 30 basis points. Disinversion continues. This is Bloomberg. Good morning.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
The dots at the September meeting had 12 of the 19 participants indicating one more hike. I'm less of that view now. I think given that, as I said, the bond market can do some of the Fed's job for it, if even some of this recent increase were to stick, I think the Fed could well be done.
That was former Fed Vice Chair Richard Clarida speaking about how his view would have changed if he were still on the Fed, Tom, taking a look at the bond market and how that influences whether to hike or not.
He's showing some courage here. He's out front on this debate. Do we need to go back to 2%, as we just heard from Dr. Giannini of Barclays? And I have Richard Clarida in a panel. He and I are doing a one-on-one late October. I can't wait for it to talk to him about the market outcomes if we get a Clarida new level of interest rates.
The pressure on whether to allow the economy to sort of go along, even if it means at a 2-point-something inflation rate. I wanted to take a look at the bank stocks because you were talking about them this morning, as well as John, about how much they have been underperforming. And in the past 2 months, just to give you a sense of the degree to which there has been underperformance, JP Morgan shares down more than 8%, Citi shares down almost 13%, Bank of America 17% decline, and Goldman Sachs down almost 13%. A big question here about why. Is this simply a profitability question, or is this something more fundamental that has to do also with businesses slowing down and potential risk in some of the most stalwart types of assets, right? I mean, that's something we've been talking about, Tom, and you've been talking about it really aggressively, about the implication for banks if you have such a massive sell-off. in one of their ballasts of treasuries.
Yeah, I mean, it's there. And to your point, is it a real economy analysis? I get that. Like, are we going to make money? Are we not? Allison Williams has been brilliant on this, among others. But I'm beyond that. I'm to standard deviation moves in bonds, not to be inflammatory, but just to at least identify price. Bloomberg with a wonderful article today that is completely price-based, not yield-based.
This was something that came up back in March, where you had banks come out and show real risk tied to risk-free assets. But then there was this Fed facility that kind of stepped in, and how much that stave off any distress from these losses. Joining us now to really understand the losses, Sri Natarajan, who covers all things banking for us here at Bloomberg, and really has dug deep into the structure. I just want to start with, in all of your conversations with all of these bankers, are they indicating any real stress that is making them truly concerned about another crisis?
They're extremely cautious. No one will talk of stress, but they are extremely cautious. And what if I tell you that the list of banks that you just put up are actually some of the better performing banks this year? When you take one step lower, you go to the regional banks, they are getting hammered. We just had a story out today looking at the shorts on a lot of those names. It is the short interest in those names at a higher level today than it was in March. That is certainly a sign. March was a tough time for many of these banks. So I want to take you back to something you said this morning, Lisa. You talked about the phrase narrative roulette in markets. I'd argue when it comes to banks, there's been narrative hibernation. They were facing severe problems. The Fed stepped in with a solution patch, but the problems didn't necessarily go away. And it's becoming increasingly clear that with every whimper and howl in markets, the Fed is not going to come back rushing to the aid of these banks. So their problems are very real. We have a lot of analysts saying that treasury markets need to stabilize for these bank stocks to stabilize. Fine. But what would cause those treasuries to stabilize right now? An indication of a cooling of economic growth. And that can't be good news for banks, especially regional banks that are a great proxy for the economy.
I take your narrative hibernation concept, that people just have this concern about crisis ongoing in their memories. At the same time, how much of the price declines have been, I don't want to say justified, but understood also in the lens of just M&A activity is coming down, loan activity is coming down, the actual loans they have, you've got delinquencies going up, and then you've got portfolios of treasuries that are losing value. Does that justify some of the moves in and of themselves without any kind of massive collapse that would warrant some additional rescue?
Big factor. The 500-pound banks, the large banks, the big banks, they are, of course, impacted by when will capital markets return. It isn't so much about M&A markets coming down or not enough capital markets activity happening. That's been the case for the last 18 months. But at this point, we were starting to hope that these green shoots will start to blossom into something more. That's not happening. That's getting pushed out. What's happening in Washington is not helping with that. Meanwhile, the challenges for the regional banks are very real and remain in place. They still have that deposit cost pressure. They're still stuck with a lot of the loans that they made when interest rates were at rock bottom levels and no easy way to get out of them. So with these treasury moves, that's not going to aid them either.
James Dimon, after he runs around Central Park, is going to go back to his house, his abode, and he's not going to dial Sri Natarajan to say, hey, Sri, let's do that interview you've been asking for. He's going to call Ashley Bacon, most important person on the planet, the chief risk officer at JP Morgan. We did this with Kelsey Barrow of JP Morgan half an hour ago. Explain to me these bond losses that I'm seeing in mark-to-market. You can't tell me they can cover this up.
Jamie Dimon is actually a very good name to talk about that, because the big challenge, and I'll take you one step next to Jamie Dimon, and that's Brian Moynihan. That stock was down 25% last year, is down another 22% this year, and that is one of the names when they had a big amount of deposit inflows.
We're going to rip up the script here right now. Folks, Natarajan yesterday put this out. JP Morgan, 15% higher than Bank of America. Now the spread's widened out. What's the problem at Bank of America?
Yeah, JP Morgan, the #1 bank in the country, is now double the size of Bank of America. Bank of America plowed a lot of its portfolio into treasuries that are yielding 2.5%. Meanwhile, when treasuries shoot out to 4%, 4.5%, 5%, possibly 6% and 7%, that's a big problem. That's not good news for Bank of America. That's not necessarily turning into any sort of realized losses, but it is certainly weighing on investors who are worried that Bank of America is is not doing enough with what it has.
Calendar item, October 17th. Moynihan's got to go mark to market or else.
Well, and he has to explain where he's going to get the capital to then do additional lending to capture some of these higher yields. John's asked this question a lot. Have we reached the point, and with the rapidity of which yields have risen, where the yield space is actually a negative for the foreseeable future for some of these banks?
It certainly feels that thing when he talked about this idea that it takes about 2 to 3 years for real rates to work their way through the real economy. The rate hike cycle started in March 2022. We're 18 months into that. This is when the pain will be felt in the real economy. A lot of the big banks are still saying that they're not seeing stress with the consumer. I don't know how much of a factor is also that they have upgraded with the kind of market that they continue to bank. So in their segment, they necessarily are not seeing the first signs of stress as they used to 30, 40, 50 years ago. But there is undoubtedly some stress developing in the consumer economy, in auto loans, in lending, and that will start to impact these banks.
Of course, the pristine customer isn't going to necessarily want to borrow at 10% rates, which is part of the issue also with loan volumes. As they have constrained capital to go out and lend, how much is private equity, private debt, the rest of the private markets complex eating their lunch?
Oh, they're absolutely licking their chops. They want to go out there and find the right opportunities. To some extent, the banks, the smaller banks especially, don't want to offload some of the loans that they've made because it almost feels like a fire sale. But a lot of these private credit shops, a lot of these private equity firms are going to be out there trying to grab a share of the traditional banking market. And they will be successful because they have a lot of capital to put to work and a lot of time on their side.
1987, I was instructed on what portfolio insurance was. It was an ugly afternoon. I remember people literally in tears on the trading floor. And every time we come around, there's a shadow out there that we don't see coming. I don't need Nataraj and gloom, but what is the identifiable shadows right now for the Ashley Bacons of the banking world?
I don't think it's so much the identifiable shadows as what's visible in absolute sunlight, which is activity is not picking up. The big ballast for the consumer banks is their investment bank. You're not seeing a lot of activity there. Everyone's talking about uncertain forward for the consumer economy, for the real economy.
So you're going to go to the real economy away from what Lisa and I are seeing in the carnage here?
Well, all I'm saying is when you don't have one side of the firm firing on all cylinders, no real sign that the other side, the Wall Street operations are going to do it for them, then there is really no great narrative to say these bank stocks are going to do really well in the next few months.
Lisa, I'm going to get 28 basis points on disinversion. We've gone from, again, I call it the Priya-Misra 100 basis points, and we've disinverted. We're going to get to a negative 28 basis points here in 2 cups of Sri coffee.
And typically that is when trouble ensues. Sri Natarajan, thank you so much. We really appreciate you being with us. I will say, as we see the moves in the market, this has been one of the question marks. When does something break? It seems like the insulation in the banking system, Tom, has at least removed that from being the circuit breaker that some people saw back in March.
It's going to be interesting to see. Highlight, particularly with these markets moving, wait an hour, Lisa Abramowitz in conversation with the president of the San Francisco Fed. This is really timely. Mary Daly is truly one of my favorite people within the racket. 12 noon today, the Economic Club of New York, Bramo and Mary Daly. Thank you so much to our team for great conversation today.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Keeping the faith in billionaire Warren Buffett. The legendary investor turns 93 this August. His signature must-read letters to shareholders have been getting shorter and shorter. This year's letter contained few fresh ideas. But most investors in a Bloomberg survey say Buffett's steady Eddie approach of buying cheap, safe, high-quality companies will beat the market. They expect returns in his investment company, Berkshire Hathaway, to outperform the S&P 500 over the next 5 years, adding to an incredible run in which Berkshire shares have returned more than 3,000,000% in the almost 6 decades Buffett has led the firm. Investors are also willing to pay up for Berkshire, which owns everything from the railroad BNSF and car insurer Geico to See's Candies and Coca-Cola. About 1/5 quantify the Buffett premium at more than 10% of Berkshire's stock price. More than a quarter say it's somewhere between 5 to 10%. There is one problem for Berkshire Hathaway, its size. Thanks to a bunch of cash-generating insurance companies, Berkshire has at least $130 billion in cash that it can put to work. But it needs big acquisitions to move the needle. Buffett calls it hunting for elephants. And we know Buffett hates overpaying. So that means sitting tight, patiently waiting for the right moment to pounce on the right company, which might be a drag on performance for now, but as Buffett fans know, usually works out in the long run.
So let's go inside the boardroom. Let's suppose you win a proxy fight and or you just get invited onto the board. You go to your first board meeting and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with a plan.
This is Bloomberg.
Following the biggest one-day pop since mid-September, we take a little bit of that back this morning. We're down about 1/3 on the S&P. From New York, good morning, good morning. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, coming up, Barclays analysts say only a stock's crash can rescue bonds. Fed officials sounding puzzled by the recent bond sell-off as jobless claims speak to a strong labour market. We begin with the big issue, payrolls, up next.
We have payrolls on Friday.
Payrolls on Friday.
Well, this Friday's job print.
We have to watch really closely.
That consumer and that labor market was something that we are very focused on.
It's all about the consumer and it's all about the labor market.
You still have a very tight labor market.
Resilience within the labor market.
So consumer is still spending.
Consumers are still out there spending away.
Until that stops, I think we're in higher for longer.
The unemployment rate is where I would watch.
If you start to see an uptick in unemployment, that would be the key thing that the consumer could tip over.
The Fed wants the labor market to slow.
Only do you see the yields start to come down once you see visible signs of economic slowdown.
When we start to see the labor market come under pressure, that will turn the tide.
Eventually, you have to imagine the labor market begins to cool off.
The question is, at what point labor market slows?
Is the bond market calm after the storm? Joining us to discuss is Lafayette's Krishna Mamani, Joanne Feeney of Advisors Capital Management. Joanne, first to you. Have we seen the worst of it?
No, John, no. I think we're still waiting to see the worst of it. I mean, yes, yields have gone up, and there's plenty of good reasons for that. One is what's happening also around the world, which is helping pull U.S. longer-term yields higher. But no, I think, the job market data came in solid today. We're still seeing firms hoarding labor. They're not throwing in the towel on the continued strength of the consumer, which is driving them to keep producing more and more stuff. So we are still waiting to see if that sentiment among firms will change, if those higher rates will actually compel them to do less in terms of expansion, in terms of building capacity, which they haven't yet done.
Krishna, you told us that the pain trade was high yields. Is this painful enough?
Well, seems painful enough. Whether it is enough to change the sentiment in the market, I think, is an open question. But the point is, I think from a fair value standpoint, from a longer term standpoint, 4.5 is a very good level given the structure of the economy. However, these things have a life of their own. And, once they get going, they can go much farther than what your fair value model would have you believe. I think we have gotten to a decent enough level for the pain trade to stop. Effectively, rates don't have to rally. They just have to stop going up. And I think that will come about when we see any bit of slowing data. My gut is that we will probably see slowing or at least stabilization of data in the fourth quarter. But that is a gut. I can't point to a good data point, a hard data point, to make that assertion.
So, Krishna, let me follow up. Is stabilizing data, not bad data, sufficient, in your view, to put a lid on the sell-off we've seen, high yields on treasuries?
Yes, I think stabilization of data, that is stabilization in a somewhat of a longer-term context. That is, we can't have a quarter like the third quarter of last year and expect rates to kind of stabilize. Having said that, third quarter was an exception relative to the last, let's say, 6-8 quarters. And I think as long as we don't accelerate from here, and as long as the trend becomes visible that things are not going to get too hot, I think we stabilize.
Yesterday, we rallied on the data I'm told nobody cares about, the ADP report. Downside surprise and everything rallied. Now, Joanne, my question to you would be, was that a decent gauge? Maybe just getting some direction from the way the market performed in response to that data. Does that give you an idea that maybe in this regime, bad news is good news?
You know, I think the interpretation of that data rightly is always a bit cautious, right? It's not very highly correlated with what's going on in the broader labor market, so it's not as helpful for investors to look at that to see what the Fed is going to do. But that said, you know, it's clear that investors are confused and watching to see how many more rate hikes are ahead of us from the Fed, and any little bit of data is going to help them try to, you know, refine those probabilities. Now, clearly, you know, rates are going to stay higher for longer. Finally, I think the market has accepted that fact. We may get another rate hike this year. Who knows? It's going to depend on the next sets of data that come out. But for now, right, what we're seeing is two consequences of that in the equity markets, right? The higher growth, higher multiple stocks being, you know, hit hard again, but also the slow growth, high dividend payers are being hurt by this alternative, the substitute attraction of high yields in treasuries and in, you know, highly reliable corporate debt. And that's hurt the consumer staples, it's hurt utilities and others that typically are, you know, clients like to rely on for income. And that's made it a tough, you know, quarter.
Joanne, if you took the bond market out of things and you looked at what's happening over the last several weeks or so, consumer discretionary struggled, bank stocks are lower, high yield spreads are wider. If you were to ask the question that Brian Levitt asked yesterday of Invesco, what is this market telling me about the economy? Never mind the treasury market. What is equities? What is high yield? What is credit? What are bank stocks, consumer discretionary telling you about this economy?
You know, I think that it's telling us that the fear of recession isn't over. And while it abated for a little while, and I think people recognize, okay, 2023 is likely to be clear of a recession, you know, we still had a lot of earnings slowdowns this year. I think folks are starting to get nervous now about those earnings projections for next year, which embed, from a ground-up forecasting perspective, about 11 or 12% growth in earnings for the S&P 500. And I think folks are starting to get a little bit worried about that and repositioning in light of higher for longer interest rates. I know you said leave aside the bond market, but those higher rates are discounting those future earnings. And I think people are recognizing that and they're pulling down valuations. The equity premium right now is really low, John, as you're aware. And that means you're just not getting paid as much to hold on to equities, which doesn't mean you shouldn't go there, but you have to have a long enough time horizon to make it worthwhile.
Krishna, do you share some of those concerns?
Well, so no, I do not. I think the core difference really is the strength in the nominal economy. And I think the nominal economy continues to do well. The third quarter was exceptional in that both real and nominal were reasonably high. But I don't see anything out there that really tells me that the nominal economy is slowing down to a level where, one, we have to worry about recession, and two, we really have to be so concerned about corporate profitability. Not yet, anyway. The key point is, you know, the question of whether we are going to have a recession or not. I think, of course, a labor market would probably have a lot to do with it, but there's a lot of other drivers in the economy that those were the things that prohibited having a recession or took out the probability of having a recession this year. And I don't think those things have slowed down to a level where we can anticipate that. I think things will slow down. I think Brian Levitt was right in that context. That is, things are slowing down, but they're not slowing down to a level where it is a problem for the equity market.
You mentioned the labour market data. Let's talk about it. We had that downside surprise on ADP yesterday. We had jobless claims looking rock solid this morning, going into payrolls tomorrow. Let's get to Mike McKee for more. Morning, Mike.
Good morning, John. That's why you've got us two-handed economists. On one hand, ADP. On the other hand, jobless claims come in suggesting that labor market is still tight, that employers are still holding on to workers. 207,000 jobless claims filed last week. That's only a little bit higher than the 205,000 the week before. We thought we might see auto workers start to show up in here because if you're on strike, you can't file for benefits. But if your plant's closed because some of the people are on strike, those remaining workers can file for benefits, and it doesn't look like they are doing that, although we saw a slight tick up in both Michigan and Ohio. Continuing claims continue to decline. So we're still seeing strength in the labor market that raises questions about tomorrow's jobs day. We've got payrolls forecast to slow down. 170,000 is the Bloomberg consensus right now. Unemployment a tick lower, and no change in the year-over-year number, but a slight rise in average hourly earnings. We'll see how all that comes out. But here's the interesting thing, John. We've had all these numbers out this week, including that ADP number, and the whisper number on Wall Street that Bloomberg collects is higher than what the Bloomberg forecast is. The forecast, as I mentioned, 170. Even this is not correct because it's got 185. Since jobless claims came out, it went up to 187. So Wall Street seems to be prepared for a stronger than expected number. So does that make good news bad news, or bad news good news?
Trying to figure that out.
Hard to know how the market is going to react to that.
Incredibly frustrating. That's what it is. Mike McKee, thank you, sir. Krishna, with that in mind, you mentioned it briefly. Good news, bad news, good news. What is it?
Well, so it isn't as much about good news, bad news. It's really about the, as I said before, the strength of the nominal economy. Let's say the number is 160 as opposed to 170 or 185. Does that change the structure of the or the outlook for the nominal economy? It doesn't really at all. I think what it does is takes away the momentum for higher yields. Doesn't mean yields go down, but the yields just stop going up. And I think that is what we need to put a floor in the market in risk assets.
So that's the data. Let's talk about the banks. The banks right now are performing terribly. Year to date, take a look at Citi. Citi year to date is down 12%. That looks weak. Take a look at Bank of America. It makes Citi look good. B of A is down 22%. Joanne, when you look at the financials, never mind the economic data, what do you take away from that?
Well, I think there was a lot more response from the banks in terms of how much they had to pay their depositors. And so there was, a change in expectations about their net income margins. Even as rates were rising, right, and they could have been doing better, there was also this pressure as depositors became far more nimble in where they were going to keep their money. But the other thing is, I think this is where we're also seeing the recession fears. Right? Yes, the consumer remains strong. We've been talking about that all year long, right? Looking at real disposable income still rising, for example. But there's a growing concern that these higher prices, inflation isn't turning negative, it's slowing down. But that means prices continue to rise and continue to eat away at the household budgets. And so, there's going to be some weakening in the consumer. We don't know if there's going to be enough to cause a recession, but clearly some slowing is in the works. And I think that's what we're starting to see in the bank stocks. Concerns also about higher regulatory weight on these companies, in the wake of the little mini banking crisis we had back in March. That's been a big impact on a lot of these stocks because it ultimately affects their business models going forward and their degree of profitability. So I think those two things, recession fears, three things, weaker net interest margins, and then the regulatory burden going up.
Krishna, out of those names, you look at that sector right now, any weakness there you want to buy?
Well, I think it's too early to buy banks for several reasons. One is, and Joanne is right on that I don't think it is as much about recession fears as much as it is about their current portfolio and the funding and the corresponding funding costs that they have to fund that portfolio. It's just that their margins are lower and their margins are going to remain under pressure. Their capital position, either on a fully marked basis, is quite under duress. I think there will be a time to buy the banks, but much like everything else in this world, it is going to be driven by what your expectations are with respect to the treasury market, because that's really the only thing that can bail out the banks from their current capital hole.
Bank earnings 2 weeks away. Christian Mamani, Joanne Feeney sticking with us. Equity futures right now on the S&P negative by 0.3% on the S&P 500 with some movers going into the open. Here's Abby.
Adding weight to the downside, John, let's check out the shares of Clorox among other laggards, but Clorox is down nearly 5% in the pre-market. This after the company essentially has pre-announced saying that they are going to have, they are having issues, actually down 5.6% on that IT hack earlier this summer in August. It will weigh on production and operations. They now believe that their net sales for the current quarter, or the last quarter, I should say, dropped by 23 to 28%. Analysts not positive on this at all. ExxonMobil down 1.7% as oil absolutely dips. Now WTI crude has an 82 handle on it. It was at 95 last week. And then finally, another pre-announcement, Rivian Automotive down 10%. They have offered a preliminary sales estimate, John, that is below the expectation. Those shares really being hit as a result.
Abby, thank you. Crude hammered in the last 24 hours. Thanks, Abby, for pointing that out. WTI yesterday down by something like 5.7%. Biggest one-day drop going back to September of last year. That sell-off continues. We're down 1.7% on WTI, $82 and about 80 cents. Coming up on this program, surging bond yields testing the Fed's drive to tame inflation.
Fed officials have had a chance at various appearances, and they've not really taken that opportunity to push back against this.
Tons of opportunity today, tons of Fed speak. That conversation up next.
Thing in life I've often said is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you will be.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
I was in the camp going into the September meeting that we would likely get one more hike in this cycle, if really just for precautionary reasons. And certainly the dots at the September meeting had 12 of the 19 participants indicating one more hike. I'm less of that view now. I think given that, as I said, the bond market can do some of the Fed's job for it, you know, if even some of this recent increase were to stick, I think the Fed could well be done.
The Fed could well be done. Former Fed Vice Chair Richard Clouder weighing in on the higher for longer narrative as long-term rates reached their highest level since 2007. Chicago Fed President Austin Goolsbee weighing in saying this: I think the puzzle people are trying to put together is why did this happen in the last 3 weeks? But if you take a 6-month perspective, I don't think it's that much of a puzzle. It's clear that the long rates coming up is what you'd expect. Ira Jersey of Bloomberg Intelligence joins us right now. Ira, is it what you'd expect?
Well, we didn't really expect it. We expected 10-year yields to kind of hover around 4.25, just based on our expectation of where short-term rates were going to go. But I do think that once you had this idea that the Federal Reserve, the market kind of woke up just a couple of weeks ago and said, hey, maybe Jay Powell hasn't been lying to us, and they're going to hold rates at 5.5%, 5.75% for all of 2024. And once that happened, you had to get long rates up somewhat, and the market kind of almost just shifted almost immediately after the last Fed meeting. And I think that it's not necessarily appropriate. I do think that we're a little bit oversold here in terms of 10-year yields, but at the same time, people were caught offside. There's a technical bit to this move, and so I think that we're probably fully priced now for what the Fed's likely to do in the medium term.
Ira, Ian Lincoln of BMO talked about the buyer's strike. That's what he called it in the Treasury market. Dalip Singh of PGIM has talked about the loss of predictability on the demand side. We've lost predictable buyers of Treasury bonds in the last couple of years. Ira, does that resonate with you?
Well, I think a little bit insofar as, over the last decade and a half or so, we've had, strong foreign demand for treasuries, particularly from private investors, portfolio investors. I'm not even talking about central banks, because central banks buy shorter-term treasuries and don't take a lot of market risk. But I do think that at this point, with yields going up in Europe, yields positive now in Japan for the first time in over a decade, you have a situation where there's less of those buyers than there are of U.S. treasuries. So then the question is, how much, at what price will domestic investors demand treasuries to be at in order for them to be enticed to buy these securities? And so I do think that there is somewhat of an adjustment on the demand side. I agree with that. I don't think it's been happening slowly, though, over the last 2 years. It's not something that just changed over the last month.
So, Ira, that's what's intriguing about the bear steepening we've seen so far. I think to some extent it would speak to that. Are we basically saying that in this bond market right now, you're not going to get me to go out the curve for less yield if we're in an expansion and jobless claims are at 200K? Is that basically what we're adjusting to?
Yeah, I think that's a big part of it. In fact, our work and a note that we put out earlier this week discussed the fact that we think about 70% of this move has been because of the better-than-expected economic data over the last 3 weeks. And I think that that's important, right? So as the data remains better, like there were a large swath of people, and there still are a few, but there's less of them today than there was a couple of weeks ago, thinking that there was going to be a recession later this year or early next year. So those people were happy to be long duration, because if you're in a recession, usually there is a flight to quality and treasuries do well. But now that we're, seem less and less likely to have a deep recession anytime soon, people who are long are just getting out, capitulating, getting risk off their books, at least going into year end.
It's certainly been the last couple of months, hasn't it? Ira, thank you. As always, sir, Ira Jersey of Bloomberg Intelligence. What a final word from our guests. I want to talk about this quote here from Barclays. There is no magic level of yields that, when reached, will automatically draw in enough buyers to spark a sustained bond rally. In the short term, we can think of one scenario where bonds rally materially if risk assets fall sharply in the coming weeks. Krishna Mamani, Joanne Feeney back with us for a final word. Krishna, a final word on that. Is that what it's going to take? Is that what we need? A sell-off in risk to get demand back into treasuries?
Well, that is one scenario. I wouldn't be that drastic. I think if you see slowdown, stabilization in the growth trend, the upward trend in yield stop. And if upward trend in yield stops, every other market stabilizes. So the scenario that they're painting is a very drastic scenario. And that can certainly materialize a whole bunch of buyers of treasury expecting a recession or a significant drawdown. I don't think it'll take that. I think more likely scenario for fourth quarter is the growth trend stabilizes.
Joanne Feeney, final word, please.
Yeah, no, I don't think we need to see anything drastic happen. Nothing structurally has changed, except that globally we're seeing just a greater demand for borrowing among all governments, and that's pushed up longer-term yields, both at the real level and at the nominal level. So everything happens at the margin, right? What we're seeing is this increase in yields required to pull more buyers of treasuries into the market, but I don't think anything needs to break or to jump from here. Where we're seeing the new equilibrium is a bit higher, and I think fiscal deficits around the world are part of that explanation. And they're not going to go away anytime soon.
They're not. And based on the dysfunction in DC, they're not going to do anything about it anytime soon. Joanne Feeney, Krishna Mamani, thank you to the both of you. Coming up on this programme, the morning calls in later, PIMCO's Mark Kiesel weighing in on the historic sell-off in longer-dated treasuries. That conversation just around the corner. Your equity market on the S&P 500 negative here by 0.3%. In the bond market, quite a turnaround. Your 30-year very briefly through 5% in the session yesterday, pulling back after that softer ADP report. Your 30-year right now 4.89. Your 10-year 4.73. Your 2-year just north of 5%. From New York, this is Bloomberg.
Back in 1997, I was interested in the following question, which is, there are a bunch of the dinosaurs called sauropod dinosaurs, which had really long, skinny necks. So Apatosaurus is an example. They also had really long, skinny tails. So I made a computer model that showed that, in fact, the tail of these sauropod dinosaurs could actually act like a whip. A bullwhip. Now, the way a bullwhip makes that cracking noise is because the tip of the whip actually goes about twice the speed of sound. Okay. I think the way they got a date was to impress the females by making loud booms.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month.
So yesterday on the S&P 500, biggest one-day rally since the middle of September. On the Nasdaq 100, biggest one-day pop going back to late August. We pulled back just a touch here. No drama. The S&P down about 1/3 on the S&P 500. On the Nasdaq pulling down by about 0.2%. In the bond market, some major moves at one point yesterday. Then we get support from a softer ADP report. Let's see if we get support from the payrolls report tomorrow. Yields on a 10-year at the moment, down about a basis point, 4.72. At the front end of the curve on a 2-year, just north of 5%. That's the price action. Let's get you some morning calls. Your first call, first up from Citi, upgrading O'Reilly Automotive to buy, saying recent declines have presented an attractive buying opportunity. Next up, Deutsche Bank naming Chubb one of its top picks within the insurance space, pointing to the company's growing presence throughout Asia. And finally, RBC initiating coverage on J&J with an outperform rating, highlighting the stock's compelling valuation and strengthening profit outlook. That stock is up by just 0.1%. Coming up on this program, losses on longer-dated treasuries starting to rival some of the biggest stock sell-offs in U.S. history. That conversation up next with PIMCO's Mark Kiesel. Your cash open is just around the corner.
thought maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
News breaks. No one covers the world like Bloomberg.
On the AI question, what we don't really see is Apple doing a knee-jerk response and moving into the domain of generative AI.
Supporters of President Recep Tayyip Erdogan celebrating late into the night, dancing and singing.
We have a fundamental reassessment of everybody's capacity within OPEC. Should we talk about $95 and $100 oil again? Not for a while.
Bloomberg, your global business authority.
From New York City,
from London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
This is Bloomberg.
25 seconds away from the opening bow this morning. Good morning. Pulling back just a touch. We're down by something like 0.1% on the S&P. On the Nasdaq, a similar move. Yesterday, really decent rally. Biggest one-day pop on the Nasdaq going back to the end of August, inspired by a weak ADP report that everyone says they don't care about. Then you get a downside surprise, and apparently everyone cares about it. There's your opening bow. Switch to the board and get to the bond market. This is what happened yesterday. Yields down aggressively. We add to that move, down another 2 or 3 basis points, 470.40 on a 10-year, after adding something like 150 basis points from the post-SVB failure lows early in spring. In the FX market, the euro trying to show some strength against the dollar, which has just been absolutely dominant over the last couple of months. 105.27 on that currency pair, up by 0.2%. And look out below on crude. All the talk about triple-digit crude by the end of the year, and here we are back down in the 80s. 82.77, down by 1.7%. Yesterday, the damage done. Severe. Big one-day sell-off, the biggest of the year so far, going back to September of last year. Apparently Cushing, the numbers look a little bit better. Gasoline demand looks a whole lot weaker, and then here we go. Big reversal. One stock to watch at the open, Clorox, the company announcing that a cyber attack that took place in August will reduce sales and profit, warning this: the impact from the attack more than offset the benefits of pricing, cost savings, and supply chain optimization. Abby has more. Hi, Abby.
Hey, John. And speaking of the worst day of the year, that is the case for Clorox right now, down more than 4%, heading to its worst day since November of 2022. So even though there was some telegraphing of this in terms of the hack, the cyber attack happening in August, and that it could impact numbers, investors are pretty surprised that we're seeing, again, the worst sell-off for the shares of Clorox on the year. Now, as you mentioned, they have basically pre-announced to the downside. They now see net sales decreasing by 23 to 28%. They're looking for a loss of 35 to 75 cents for the quarter that ended in September. So really a pretty negative issue there. And it's a matter of operations, inventories, supply chains. That is where the the hack really has weighed, that they're not able to have the proper products. And it's thought that Scattered Spider, a group of hackers that were tied to recent cyber attacks on casino companies such as MGM and Caesars, could be a piece of it. Something I'd like to point out here, John, so of course the street is somewhat skeptical on this and cautious on it. This stock on the pandemic, if you recall, everybody wanted to buy Clorox in the time of the pandemic. It rose 66% between the start of the pandemic and the pandemic peak. Well, now it is down about 50% from that pandemic peak. What goes up must come down.
Amazing. We're down about 3.9%. Let's call it 4% lower. We've talked about that cyber attack threat for such a long time. It showed up in a pretty unexpected place, I have to say. Clorox, a whole lot lower this morning. For the broader market, about 2 or 3 minutes into the session, we're down here by not even 0.1% on the S&P. Similar move on the Nasdaq as well. Want to stick with consumer discretionary. Constellation Brands. raising its annual profit target after topping sales expectations. The CFO saying this: the record top line and operating income performance of our beer business has enabled us to keep delivering on our priorities. Simone Foxman on top of this story. Hey, Simone.
Yeah, John, beer very strong, but we're looking at shares actually down now, early in the session, down 2.3%. Even though the company beat comparable earnings per share guidance for the full year, now sees EPS 370 versus 317 year on year. The estimate was 339. Full year guidance beating the average analyst estimate. Analysts were looking for 1167, but now the company is saying for fiscal year 2024, it expects profit between 12 and 12.20 per share. Beer income really leading the charge here. Beer sales were up 12% year on year. Most analysts had anticipated a rise of about 10%, but wine and spirits incredibly weak and much weaker than had been anticipated. Operating income in that segment down 19% year on year. I think the question mark here is really about the durability of these sales, because a lot of the reason people are buying Modelo beer, that's Constellation Brands beer, is because of missteps by a competitor, by AB InBev, around its Bud Light advertising campaign that included Dylan Mulvaney, a transgender woman. So maybe the question is about durability. Maybe the question is about just the size of those beer sales, considering some analysts likely thought the beer sales would be higher, but now we're seeing shares down over 2% this morning.
Down over 2% to 243. Simone, thank you. Let's turn to the autos. Rivian announcing plans to issue $1.5 billion in convertible debt and reporting preliminary Q3 revenue. Isabel Lee has the numbers. Hey, Isabel.
Hey, John. So these green senior convertible notes due in 2030 are private offerings to qualified institutional buyers. And Rivian also is extending an option for buyers to purchase an additional $225 million. So the bond issuance, of course, could dilute the current shareholders' interest, but Bloomberg Intelligence is saying that the timing makes sense. But this, of course, comes after Rivian has disappointed investors earlier this week when it maintained its full year guidance of 52,000 battery EV vehicles this year. So Rivian also said it expects revenue in a range of $1.29 billion to $1.33 billion. So that's roughly in line with estimates. So Rivian, like others, has really struggled with supply chain issues as it plays catch up with Tesla. The company went public in November 2021 and has fallen around 80% since then. But year to date, it's up 30%. For now, though, it's really plunging by around 13%, John. But we'll know more when the company releases its earnings on November 7th.
Looking forward to that. The stock is getting absolutely hammered between now and then based on this move. Isabel, thank you. Let's turn to tech. Amazon and Microsoft Cloud Services facing an investigation by the UK's antitrust watchdog over concerns of market power abuse. The Competition and Markets Authority CEO saying this: many businesses now completely rely on cloud services, making effective competition in this market essential. Katie joins us with more. Hey, Katie.
Hey, John. Yeah, the CMA launching an investigation into the UK's supply of public cloud infrastructure services. Now, this follows a years-long study from telecommunications regulator Ofcom, which found evidence that major players, including Amazon, including Microsoft, have made it difficult for customers to use multiple suppliers or actually switch suppliers. And as CMA CEO Sarah Cardell said, both Microsoft and Amazon, they provide increasingly essential remote storage and computing. And currently, both of those companies make up between 70 to 80% of the UK cloud market. And now, if significant issues are found by the CMA, they do have the power to impose structural remedies that could include selling off part of their businesses to really improve competition here. But the CMA's market investigations, they typically last around 18 months, John. So we're going to have to wait until about April 2025 or so to actually see that report.
2025 feels like a long, long way away. Katie, thank you for the update there. Amazon down by 0.8%, Microsoft up by something like 0.4%. The broader equity market, about 6 or 7 minutes into the session, is almost totally unchanged on the S&P 500. On the NASDAQ 100, it is totally unchanged. Year to date, if you want those figures on the S&P 500, we're still positive by something like 11% on the S&P, and on the NASDAQ up by more than 20. Keeping an eye on the bond market, the losses there absolutely dramatic. On longer dated treasuries, they're approaching 46% since peaking in March of 2020. That's just shy of the 49% decline in US stocks during the dot-com bubble. Joining us now to discuss, PIMCO's Mark Kiesel. Mark, it's been too long. It's good to catch up, sir. Can we talk about those monster unrealized losses, for some people at least, in the treasury market? Mark, have we seen the pain from all of that earlier this spring? Have we left that behind?
Jonathan, we think most of the sell-off is overdone. If you look at what's caused treasuries to back up, it's been a strong economy, it's been high inflation, and also chronic deficits, which has led to a supply and demand imbalance in the treasury market. But we really do see three catalysts for lower yields over the next 1 to 2 years. First, nominal growth has peaked, it's slowing. Secondly, inflation has peaked, it's coming down, the Fed is credible. And third, there are rising recession risks. This monetary policy is now restrictive. Importantly, these rates right now, both nominal and real, we haven't seen these, Jonathan, in 16 years. So actually, we think bonds are very attractive here. There's been a very great time right now to move out of equities into bonds. We think you can get basically near equity returns in the bond market. We have not been able to say that in 16 years. So we're quite positive on bonds right now.
Mark, when you say in the bond market, credit specifically, treasuries, all of the above, the whole universe?
We specifically like shorter maturity, high quality bonds right now. You don't have to extend out the yield curve. You can get basically 6 to 6.5% by focusing on very, very short duration, high quality corporate bonds. Importantly, companies are throwing off significant free cash flow. They're delevering their balance sheets. The opposite is happening at the government, where governments are taking on more debt. Debt to GDP is rising. That's not happening in the corporate bond market. Fundamentals are improving. Companies are using all this excess cash flow to delever, pay down debt. And importantly, at these higher yield levels, you're going to get less supply and more demand. That's not what's happening in the government market, the treasury market, where you're getting more supply. So you've got more favorable fundamentals in corporate bonds, more favorable technicals, and valuations we haven't seen, Jonathan, in 16 years. This is the time to buy high quality, short duration corporate bonds.
Mark, I've got to say, you sound really bullish. When was the last time you were this bullish?
Jonathan, we have not been this bullish in a long time. It literally was back when we had the ring the bell moment, over 3.5 years ago, March 17th of 2020. So we are very bullish on short maturity, high quality investment grade bonds right now.
So when I look at spreads, they still look pretty tight. High yield spreads are something like 420, went through 400 in the last few weeks or so. Mark, some people might say that's not wide enough. There's weakness to come next year in the economy. Beyond that, we've got that maturity wall in high yield that's going to kick in as well. There's a lot of companies that need to supply, come to market, raise some money. What's the argument against that, Mark?
Well, Jonathan, the argument against that is that we've seen unprecedented growth in the economy, and companies have termed out their balance sheets. There's very little short-term debt coming due. If you look at the last year, there were 14 times more upgrades than downgrades. So companies, per my earlier comment, companies' fundamentals have been significantly improving. This is the opposite of the United States government, where fundamentals continue to deteriorate. So while companies are paying down debt and delevering, the government is relevering. And so basically the credit fundamentals are much stronger for most of these companies than for the government itself in terms of trajectory.
Let's talk about favorite sectors right now, Mark. What are they for you?
So, Jonathan, we've talked about this over the last year, particularly when you visited us in Newport Beach. Fun. We love fun. Fun is basically what people haven't been doing for 4 years. They're getting on planes. They're staying in those hotels. They're going to Vegas. They're spending money on concerts. This is where PIMCO's been invested for the last 2 to 3 years. And these companies are generating so much excess cash flow, they're able to delever that balance sheet significantly. They're not rewarding shareholders. They're actually delevering. So they're doing, again, the opposite of what the government is doing. This is exactly, as a bondholder, what we want to see. So we love fun, and fun is where the opportunity is.
So airlines, hotels, cruise lines, all of the above?
All the above. And in addition, if you look at some of the highest quality American banks today, these companies literally generate 8 to 14 billion of profit a quarter, and you're getting paid now 6 to 6.25 for 5-year maturity bonds. We have not seen this, Jonathan, in 16 years. This is really a huge opportunity.
So, Mark, I want to wrap it up. You've said this a few times in this conversation. They're deleveraging. The US government is not. The credit call is super bullish. Mark, what is the Treasury call? Are there deep-seated concerns about where this is heading?
So, Jonathan, we think the Fed is close to being done here. The Fed looks a year forward and sees unemployment rate at 4.1. we see unemployment rate going much higher to 4.5 to 5 over the next year. So we do think this slowdown is coming with the economy, and we think you're not going to be able to buy these yields 1 year from now. So now is the time to start extending that maturity wall. Bonds very attractive today.
Mark Kiesel, thanks for the update. Mark Kiesel of PIMCO there, super bullish on this bond market. Haven't heard Mark like that for a long, long time. Mark, thank you. The broader equity market, just a little bit lower, down 1/4% on the S&P. On the NASDAQ, we're down about 1/3 of 1%. Coming up, the race to replace Speaker McCarthy heating up.
It's not just about the person. Both of these folks are honorable men. It's about the plan they have to reduce spending.
The Congressman Matt Gaetz back in the latest bids from Congressman Jordan Scalise. The latest from Capitol Hill, up next.
Let's look to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It was unimaginable that we would see rates move this fast. That was not in the realm of thinking.
Just the timeline of what they knew and when they knew it. Why didn't they do anything about it?
When do we have to see the kill? It's for the Fed to respond to it. And this is really the tension.
Be informed.
You cannot be overly data dependent. You've got to have a view of where you're going.
Be prepared.
I think the earnings season might actually be the positive surprise that people are not expecting.
Be ahead of the game.
Certainly the beginning of something we need to keep an eye on.
And that, I think, is really going to be an interesting takeaway from this moment.
You go all birds on us and you say, turn, turn, turn. Is that what we're doing right now?
Yeah, big question coming into this year for us was, when is that turn going to be?
What a fantastic conversation.
The news you need.
The president's calling on manufacturers to make more in America. It is working, and it's reflected in these jobs numbers.
The analysis you trust.
How do you take this anecdotal data and say, really, just focus on the now, because that is going to tell you where we're going?
What is the measurement of uncertainty that we have in studying the American economy?
Milton Friedman had said there are long and variable lags in the impact of monetary policy. But man, it's a long slog.
The best way to start your day.
People are tuning into this program on a daily basis.
Oh, come on, it makes for good TV.
Let's move on.
Bloomberg Surveillance, weekdays from 6 to 9 a.m. Eastern. These CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. ON's running shoes have a unique look, and so does its leadership team. CFO Martin Hoffman is also co-CEO, and he thinks two jobs are better than one.
How do you balance those two roles?
I feel the CFO makes you a better CEO, and the CEO makes you a better CFO.
Watch Chief Future Officer this Wednesday on Bloomberg.
It's not just about the person. Both of these folks are honorable men. It's about the plan they have to reduce spending. I'm for both of them right now. I'm eager to hear their plans and their vision. But if the House of Representatives goes from the stewardship of Kevin McCarthy to either the stewardship of Jim Jordan or Steve Scalise, that's going to come to the delight of many conservatives.
The battle for House speakership heating up. Second-ranking Republican leader Steve Scalise officially joining the race, making him a top contender. Conservative Jim Jordan also announcing his run. McCarthy's successor faced with the task of avoiding a mid-November government shutdown and patching up intra-party conflict. This as Fitch Ratings downplays the impact of a potential shutdown, telling Bloomberg, quote, "We don't think that the political brinksmanship or even a government shutdown in the coming weeks would affect America's stable sovereign rating." For more, let's get to Bloomberg's Anne-Marie. AMH, what's the latest?
Well, John, as you've outlined there's really two top contenders right now, and it's House Majority Leader on the Republican side. That is Steve Scalise. He's number two. He's talked about it in a letter that he's been the individual that's been able to really hear out all the diverse views of that caucus. One potential issue with him, Jonathan, is that in August, he announced that he was undergoing treatment for blood cancer, but he still says he feels good and he wants this position. Then you have Jim Jordan. This is a staunch ally of former President Donald Trump. This is someone who also was very loyal to Speaker Kevin McCarthy. Before that motion to vacate, he told Joe and I on Balance of Power he does not want to be Speaker, and he supports Kevin McCarthy. With Kevin McCarthy gone, he thinks potentially he can be that person that is able to bring this party together. The issue is, can he garner support for some of these centrist districts where, yes, their congressman or woman is a Republican, but they voted for President Biden. The biggest issue, Jonathan, it's just not obvious at this moment, is who can get to 218.
So true. I think it's interesting right now that, Anne-Marie, you've got Republicans fighting with each other as Democrats start to sound more like Republicans. I'm talking about border security at the southern border. AMH, I think this is such big news for this country. What a change of course for this president.
Absolutely. This president said he wouldn't add an inch to the border when he was campaigning. This is the border that Trump continually talked about, how he wanted to build a wall. And now they're going to be adding about 20 miles to this border. There was a notice published from the Department of Homeland Security about this. They're having to forego some of these laws to get this border enacted. But, Jonathan, this isn't just pressure from the Republican Party that is likely putting a lot of making the Biden administration want to move on this. It is pressure from his own party. Governor Pritzker sent a letter to Biden yesterday. You constantly hear from Eric Adams, the mayor of New York. These Democratic-led cities, these Democratic-led states are saying they need more help and aid from the federal government because they are also dealing with a migrant crisis.
This is a really big change. Anne-Marie, I'm looking forward to the program a little bit later. Balance of Power with AMH and Joe Matthews together with Katie down some of these big issues. Let's turn to strikes. UAW negotiations with Detroit's Big Three reportedly progressing. The union president, Shawn Fain, set to give an update tomorrow. This as Kaiser walkouts enter a second day in the largest U.S. healthcare strike in recent history. A union spokesperson said this: frontline healthcare workers are awaiting a meaningful response from the company. Key priorities including safe staffing, outsourcing protections for incumbent healthcare workers, and fair wages to reduce turnover. Katie has the latest. Hey, Katie.
Yeah, John, this strike is 3 days for Kaiser Permanente workers, or a coalition of unions representing them. That in total represents about 40% of the total workforce. This could affect healthcare services for nearly 13 million people, non-essential services like routine doctor's visits, for example. What the union wants is some of what was just laid out there. In addition to wages, this is about combating staff shortages, providing protections for these workers. What's interesting, though, about this strike, John, is it is temporary in nature. Because of healthcare union federal restrictions, they have to return to work, even if there is no deal by October 7th. So this is going to be short-lived. That's not to say that they couldn't strike more later on, but for the time being, this is only going to last for a 3-day period. That, of course, is not the case when it comes to the UAW strike, which is about 3 weeks in length now, with no clear end in sight. And of course, we will expect another Friday update from Shawn Fain in regard to progress in talks with the Big Three, potentially another escalation of the strike. Of course, we have seen Stellantis and Ford each spared escalation at least one time. Ford, of course, earlier this week made a sweetened offer to the UAW, more than 20% wage increases, bigger contributions to the 401k and the like, though Ford also has laid off another couple hundred workers, bringing the total layoffs related to this strike to about 1,330. GM, meanwhile, has not been spared any any escalation thus far. And GM said yesterday that the total cost of the strike for them at this point is about $200 million, which is why they have secured a $6 billion line of credit to build up liquidity, which is kind of a sign that this company, GM at least, is gearing up potentially for a prolonged work stoppage. We'll wait and see what real tangible progress Sean Fain details tomorrow.
Much longer already and deeper than many of them were hoping for. Katie, thank you for the update. We'll get an update from UAW tomorrow. On the same day, we'll get an update on the labour market in America. The payrolls report just around the corner. The estimate at the moment, 170,000. The previous number, 187. Let's get you an update on this equity market right now. We are about 22 minutes into the session on the equity market, pulling back by about a third of 1% on the S&P, down by about 0.5 on the Nasdaq. With the sector price action, here's Abby.
The sector composition, John, looks a lot more bearish than that relatively modest decline. 10 of the 11 S&P 500 sectors are lower, led by energy, communication services, discretionary utilities, kind of flipping around down there, down more than 0.5%. The one sector higher is healthcare, up about 0.5%. We've been talking about energy, and I really love the fact that you're pointing out that yesterday's decline for oil was the biggest since September of last year. If we take a look at the last 5 days for oil and two of the different energy sectors, we're going to see a bit of red on the screen here. There's New York crude down 9.4% in just 1 week. The service equipment sector down 10.3%, and there's the energy sector down 7.83%. This, of course, is the dollar is rising, and there were some stronger inventories for oil yesterday, John.
What a difficult week it's been for everything associated with energy. Abby, thanks for that. Coming up, your trading diary, looking ahead to all the events to get you to the weekend and out the other side. From New York, this is Bloomberg.
Are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new bank rate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
25 minutes into the session, pulling back just a touch here on the S&P by 0.2%. As the price action, here's your trading diary. The events you need to look for through the next 24 hours or so. More Fed speak coming through the day. Kashkari, Barkin, Barr, plus don't miss Bramo's interview, conversation with San Francisco Fed President Mary Daly at noon Eastern Time. The prosecution continues its case in the Sam Bankman-Fried fraud trial, and on Friday, tomorrow morning, the main event, the payrolls report just around the corner. You're familiar with the estimates so far. Here they are again. 170,000 is the number we're looking for. Stacked program tomorrow, including Mohammed Al-Arian and Mike Collins, regular guests of this program. We'll catch up with Victoria Fernandez as well, and the Labour Secretary, Judy Su, from New York City. This was the countdown to the open. This is Bloomberg.
hardest thing in life, I've often said, is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like. But the more you could be you, the happier you will be.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question its industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays. This is Bloomberg Markets with Paul Sweeney and Matt Miller.
We got a lot of green on the screen here, but the volume is light.
We constantly underestimate the strength of the U.S. consumer.
This is a market that's much more optimistic or bullish than maybe the central bankers are.
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
The supply chain has still got dislocations globally and here in the U.S.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Good Thursday morning from the Bloomberg headquarters, 731 Lexington Avenue. We're on the 6th floor here, the link, as it were, because we're broadcasting live from the Bloomberg Sustainable Business Summit, where Bloomberg brings together business leaders and investors globally to drive innovation and scale best practices in sustainable business and finance. So we're going to have lots of good guests throughout the day from this conference talking about the global sustainability business and how investors and businesses can work together. Plus, later today at around 12:10 Wall Street time, Lisa Bromwitz is going to be sitting down with San Francisco Fed President Mary Daly at the Economic Club of New York. So we'll bring that to you live as well. But let's kick this whole thing off. Let's go to John Tucker and see if we can get a Bloomberg business flash.
Yes, you can. Risk-off kind of day, Paul, in the early going. The data we got this morning showed continued resilience in the jobs market. That's good news, right? Well, not necessarily. It raises the idea maybe the Fed has farther to go in its interest rate hiking campaign. Right now, you have 9 of the 11 major industry groups in the S&P 500 lower. Joe Quinlan at Bank of America Merrill Lynch says, you know what, the recent rise in yields, that is still clouding the future for stock investors.
Well, it makes our job, being an equity investor a lot tougher in terms of the alternatives. The money market funds continue to grow. So as an equity investor, it's very much challenging in terms of finding that value. Even dividends. Dividends used to be a layup vis-a-vis equities, but not anymore. So it's challenging.
Yeah, right now the S&P 500, 17 points lower. That's down 0.4%. We're at 42.46 on the index. The Dow Jones Industrial Average, 46 points lower. That is down 0.1%. The NASDAQ 100, 119 points lower. That is down 0.8% right now. Some of the individual shares on the move. You have Rivian Automotive falling about 16%. The electric vehicle maker announcing plans to issue $1.5 billion in convertible debt. They also reported preliminary third quarter revenue. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Matt and Paul.
All right, John Tucker, thank you so much. We appreciate that. We're live at the Bloomberg Sustainable Business Summit, brought to you by Ecolab Water for Climate. When businesses reduce water use or increase efficiency, they can save energy while reducing emissions and costs. More at ecolab.com/water for climate. Matt Miller and Paul Sweeney here. We are on the 6-4 link, and we're also streaming on YouTube. We're still doing that today, so you can go to youtube.com and check us out.
Which is pretty cool. Actually, if I'd known we were going to be up here, I would have worn my more sustainable outfit.
Oh, you have a sustainable outfit?
Yeah,
okay.
Exactly. 100% recycled. And
from bottle caps.
Exactly, made by old Wall Street retaillees.
Yes, exactly.
You know,
right. That's what they do in their life. All right, looking at these markets, a little bit of red on the screen, not much to speak of. Let's check in with Bailey Lipschultz. He covers all the equity markets for Bloomberg News. Bailey, what are you looking at?
Yeah, a bit of weakness, obviously, still in a market driven by the macro. Payrolls data tomorrow, inflation numbers next week. That's going to be the big driver. Obviously, all eyes are on yields. But looking at some of the individual movers, JT mentioned Rivian down about 16%. The big thing on this
RIVN. You've got to always say the ticker.
Sorry.
Remember.
RIVN.
Yes. Is it only when it's an auto car? Automobile stock?
What, you mean of
the ticker?
The ones that Bailey's talking about?
Yeah.
Or I don't know what other stocks he's got lined up, but I'm just saying whenever you say a company, someone who does movers like Bailey or
I
Jess,
see what you're saying. Okay.
you've got to include the ticker. Kriti Gupta, I think, kicked that off, and now we want everyone to always include the ticker.
All right, so RIVN,
Thank
also
you.
in the ESG space. So,
there you go. We're tying
things
it all
working
together.
out. But down 16% after a convertible bond, convertible debt plan. Big thing for that, issuing a $1.5 billion worth. Looking at some of the reaction.
Big convert, man. You got to have a big float to take that kind of convert.
And that's why it's down.
I know.
And Evercore's came out saying that they expected this to $2 or $3 billion second half of next year. So pulling this forward, company needs to spend a lot of cash to, outfit
Converts. I pitched a lot of converts in the day, and it's dicey, man. I don't know.
Really? I was having lunch with a guy yesterday who was like, thank God the convertible market is coming back.
It is coming back a little bit, yeah.
I wonder if it's debatable whether or not Rivian is really an ESG company, right? I mean, you're saying because they make EVs.
Oh, they're all in ESG.
Yeah, but they're pushing an industry that's going to drive so many people out of jobs, you know?
We don't know that.
Well, you don't need nearly as many people to build.
Mary Barra doesn't say that.
That's true. She disagrees. But I think she's looking at a more holistic version
thing.
of GM.
Okay.
And in general, you need far fewer people to build an electric car than you do a gas vehicle.
So the pro and the con on the ESG front.
Yeah. Plus, I mean, I'd like to see, and I'm sure BNEF has done this, but a total analysis of the carbon footprint when it comes to everything, starting with, mining cobalt in the Congo. How sustainable is that?
Definitely not good for the environment.
Probably not great. Processing it in China and then shipping it over here.
Okay.
Tough.
A lot of things going on. One of the stocks also underperforming, Clorox, ticker CLX.
Nice.
For those of you hanging out on your terminal, down after preliminary numbers. Big thing for this company. One of those targeted by the IT hack. Big thing is that they're expecting mid-single digits organic sales growth in the quarter, but investors and analysts really cautioning that the ongoing operational impacts from that hack are going to continue to plague the company. Obviously, we saw Caesars and MGM being impacted by their own hacks, but that's one thing to keep an eye on in kind of an uncertain environment for what was a huge pandemic darling.
I love this story also that, such an old economy maker of bleach could be brought down by IT problems. It's like if Bart goes to the box factory and they say how excited they are about AI.
Well, and then the interesting thing is, right? So this is a company that distributes obviously things like bleach and wipes to retailers. So when they have to kind of pull the plug and temper down some of that automation, that's when you're seeing this impact really playing out. And that's why there's a lot of uncertainty about how long this impact is going to continue to weigh on operations. Another company that started out lower in the pre-market, now trading a touch higher, is ConAgra, ticker CAG. Debate on this really coming into the expectations, whether or not their volumes can continue to deliver. So first quarter volume is actually declining more than expected. Guidance for 2Q trailed estimates, but it does seem like maybe a bit of investors' forgiveness rotating back into the company, which for the most part, when you look at the print, not great, but not terrible in terms of where they had been forecasting and where they had been talking up. Another company on the move, Lamb Weston, ticker LW. They're the potato maker, so they sell products to, I mean, not potato maker. Lamb Weston, they sell potato products. So you go to McDonald's, Lamb Weston. If you buy those tater tots at your frozen grocery
French
store.
fries, best French fries in fast food, McDonald's. Matt, let's say you.
I don't, I haven't eaten McDonald's for, I'm going to say, at least 23 years.
Well, that's your problem.
And I mean, yes, the fries are good in the moment.
Yep.
But it's the kind of thing that you always regret. And
But this was a discussion.
God
of
forbid you eat
best
them in the
fast
car.
food. Oh no,
dude,
that's not
because
that's a non-issue.
you'll never get that stink out of there.
Bailey, best
In-N-Out.
fast food. In-N-Out
Far and
fries.
above. I love it.
For the fries?
I think their fries are better than the burgers. I
Wow.
think if you're going for a
That's
better
freshly cut potatoes
burger, you're
right
just
in front of you.
watching the people
Yep.
hammer it out. You
Yep.
get that sauce,
I like that.
the
Yep, I like that.
spread, throw it on.
All right, good stuff. Anything else?
Constellation Brands, ticker STZ, boosting their outlook. Another company that the expectations, kind of what the buy side was really looking for, actually higher than what the sell side was forecasting. So that's why the stock's down a touch.
Okay.
Modelo
All right.
maker.
Okay. Very good. Bailey Lipschulte covers all the equity markets for us. We appreciate that. So we're here on the 6th floor. I kind of like broadcasting here. You get to see everybody kind of walking by.
Yeah, I like that too.
Yeah.
It's cool. I mean, we have the fishbowl in a
we
sense.
have the fishbowl.
Downstairs in our Bloomberg Interactive Broker Studio, you can see in and out. And
Yep.
we have really cool tech in terms of flashing stock prices or headlines, for example, across the outside of the studio.
Yep.
But up
this
here,
is also called the Link because Bloomberg HQ in New York is actually two towers, if you will, or two separate buildings, and this thing kind of links the two.
Right. Well, in every Bloomberg office that I've ever been to, in terms of the major cities,
Yep.
right? So Berlin, London, New York, there's always one common place that everyone entering the building has to come into before you can
Go to
go
your
off
desk,
to your individual desks.
So it makes a lot of sense when people actually come into the office.
Yes.
That works well then, doesn't
Yeah,
it? All right, so we're here at the Bloomberg Sustainable Business Summit. Part of that is financial inclusion. Let's define what financial inclusion is and how do we measure it. Kara Hugenson joins us, Senior Vice President and Head of Workplace Benefits at Benefits and Protection Principal. Kara, thanks so much for joining us here. We appreciate you coming here to Bloomberg. What is financial inclusion and how do you measure it?
So financial inclusion is about giving more people access to tools, products, services that enable them to ultimately, the goal is achieve financial security. And so making sure that a much broader group than today has access to all that they need in order to make those decisions and achieve financial success. You know, it is partly about measuring the access, the number of people that do have access to those products and services, but then it's also about their degree of comfort and security long term, which is a bit subjective because that's going to look different for everybody. But we have a huge opportunity ahead of us to make sure that just that access is taken care of. Principal created an index called the Global Financial Inclusion Index last year. We just this week released our second edition of that. Okay. And it measures financial inclusion across 42 different markets.
Different markets in terms of countries?
42 different countries, and really looks at the role of 3 pillars in each of those countries: the government, the financial system itself, and the role of employers. And so we can measure each of those pillars by country and then aggregate that to determine kind of relativeness around financial inclusion. One of the things that this year's particular index showed is that those countries that are making the biggest progress in terms of financial inclusion are the ones that are making investments to digitally enable access to products and services. Think mobile banking, real-time payments, those types of solutions, which inherently, because so many of us, and an ever greater percentage every day, have access to those computers we hold in our hands. And so that's a really important component of financial inclusion, the tools at people's fingertips.
So I imagine we were just talking about holistic systems, and this isn't something that you're doing because necessarily you feel sorry for the people who aren't included. It's not about charity, right? I mean, in some senses maybe, but really it should be good for the entire society if you include more people. So do you see a correlation between those markets that are more financially inclusive and, say, you know, stronger, more sustainable growth?
Absolutely. So great, astute question. So not only did we develop this index, but beyond that, we compared that index to different indicators of overall economic progress, and there is a strong correlation there. Countries that have greater financial inclusion are more resilient, whether it's resilience to climate change, whether it's resilience to geopolitical risks. They ultimately are more ethical economies, and that leads to happier, more more food secure individuals and brighter prospects for the future.
How does the U.S. rank on your index?
So the U.S. actually currently ranks number 4. 4. We actually dropped a couple of spots from last year's rankings, and there were a variety of factors that went into that. One of which is, you know, just consumer sentiment is an underlying consideration in this research, and consumer sentiment is changing given, you know, all the different factors, whether it's the economy and concerns related to that, politics, the news cycle, all of that feeding into overall consumer sentiment. So
who's number 1?
Yeah.
Singapore is number 1.
No surprise there.
Yes,
from my
very strong on all 3 pillars.
So much easier, though. It's almost unfair, right? I mean, it's a much smaller market.
It is, yeah. But there's also been a lot of intentionality around how those 3 different pillars all pull their own weight in order to create a very financially inclusive country.
And they have, I think, it's easier with a centrally controlled economy, right? It's probably more difficult with totally chaotic and broken democracy like we have here in the U.S.
There are definitely different sets of challenges when not all the oars are rowing in the same direction.
What are some of the countries that are, you know, maybe making big gains or maybe have some real challenges in front of them?
You know, I would say back to the comments around, you know, digitally enabling, you know, places like Taiwan and Vietnam are making some pretty significant gains because of the infrastructure investments that they are making to enable their citizens to access financial products and services. And beyond that, it's also the education that goes with the use of those products and services.
Are there any big laggards that surprised you? Any countries that you think should be making more headway?
Not specifically country by country. I think, you know, it's probably not a surprise that developed markets that have more resources to support their citizens generally rank higher on the index, and, you know, emerging markets tend to fall lower on the index. But again, the digital component and investing in infrastructure to support digitization is really key, and those countries doing that are making the most progress year over year.
How about for women? I'm not sure if it's just U.S. or just kind of what generally your findings are. Women, do they feel more or less inclusive relative to maybe the general population?
Sure. So the short answer to that is they feel less included. They have less confidence, and their perceptions around money management and investing are different than men. There's recent research that Principal did with Her Money that just reaffirmed that. I think there's very few people that would say they wouldn't benefit from additional education and advice, but in particular, women will significantly benefit from that.
Well, here's a good little story. Just from yesterday, I had lunch with my 27-year-old daughter. We spent most of lunch talking about investing. Like
Good
she
for
went,
you.
and she's got that Marcus savings account, and
she's got a high interest rate there.
Yeah, she's
5%.
got a high interest rate there. She was just kind of asking a lot of questions about kind of what to do, and
That's great.
Yeah, so I was like, nice.
And she's listening to Dad.
Exactly.
True.
Exactly.
I would say
there's 1 out of 4.
She probably has a head start compared to most other women in the world, though.
Right.
You know.
That is very, very true. And that often is one of the issues, is just this overwhelming feeling of where to start. They may, a lot of people don't have a dad that can talk with them,
Yep.
over a meal to, answer those questions. And if you do a search on whatever your browser of choice is, you know, the amount of information that is at someone's fingertips doesn't make that process easier.
All right, Kara, thanks so much for joining us, Kara. Really appreciate it. Kara Hugenson, she's a Senior Vice President and Head of Workplace Benefits at the firm is Principal, correct?
Correct.
Awesome. So we got it there. So we're just talking about the financial inclusion. They've got a cool index there that kind of measures that. The U.S. is ranked number 4. We got a little work to do there, folks. Let's get out there and get it done. This is Bloomberg. Let's get some company news right now. I'm going to guess Lisa Mateo.
Good morning. Clorox has more cleanup to do after a recent cyber attack that cut into its production. More from Bloomberg's Abigail Doolittle.
They have basically pre-announced to the downside. They now see net sales decreasing by 23 to 28%. They're looking for a loss of 35 to 75 cents for the quarter that ended in September. So really a pretty negative issue there. And it's a matter of operations, inventories, supply chains. That is where the supply, the hack really has weighed that they're not able to have the proper products.
Now, Clorox is also blaming the same group of hackers that hit casinos at MGM and Caesars. Shares right now, they're down about 8%. And a scandal is spreading for General Electric over engine parts from a UK distributor. Bloomberg's Valerie Titel has that story.
These spare parts, which range from simple nuts and bolts to more critical turbine engines, went into dozens of jet engines made by a General Electric joint venture during maintenance work. These engines were then installed back into popular Boeing and Airbus airplanes, and GE says they've identified 126 of those jet engines.
Right now, shares down about 0.6%. And if a cruise is in your plans, you'll have to pay more. In order to offset higher fuel prices, Carnival tells the Wall Street Journal that it's raising the prices on its trips rather than placing a fuel surcharge. No word on how much that cost will increase. Carnival shares right now up nearly 3%. So where can you save money? It's over at Disney. The theme park slashing the price of its tickets for kids by up to 50% for a limited time to attract more visitors. Disney shares right now, they're up a fraction.
Headlines and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. We are brought to you by Anshin Accountants and Advisors. Does your relationship with your tax advisor still add up? Is your advisor proactive to help minimize taxes, increase cash flow, and create opportunities? Well, if you're not getting the service you deserve, visit Anshin.com today. It appears traders are kind of hesitating to make any big bets ahead of tomorrow's monthly jobs report. Treasuries mixed, and oil extending a retreat there at WTI crude. This is West Texas, reaching just above $83 per barrel. The wild moves across the markets we've seen lately, driven by bond yields soaring to multi-year highs. Right now, the 10-year, that's actually down 1 basis point, 471. The 2-year, 3 basis points lower, 5.02%. We'll give you the long bond. That is up 2 basis points right now at 488. Now, we did get data this morning, the jobless claims data. That still keeps another rate move from the Fed on the table, which is why part of the reason you're seeing the risk-off mood today. S&P 500 down 16 points. That is down 0.4%, 42.47 on the index. The Dow Jones Industrial Average down 31 points. The NASDAQ 100, 129 points lower. That is down 0.9%. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Matt and Paul.
All right, John Tucker, thank you so much. We appreciate it. Matt Miller, Paul Sweeney, we are live at the Bloomberg Sustainable Business Summit. We are located today on the really cool 6th floor interconnect. I think it's called the Link here at the Bloomberg HQ, 731 Lexington Avenue. Pretty cool spot.
It's very cool. So if you work on, doesn't matter if you work on the 29th floor or the 3rd floor, when you come to work,
you got to come here.
You got to come to 6 first.
Yep. Get
You
your
grab
coffee.
a coffee,
Yep.
exactly, or whatever your beverage of choice is, and then, oh, cool, there's John Authors.
Oh,
that
look at him.
reminds me, by the way, we're at the Sustainability Summit, but nothing matters today other than rates, right? I mean, holy camole. The kind of crash that we've seen in long bonds is something that is historic. I mean, they've lost half of their value. I read the, maybe in John's column, the bonds due in 2050 that were yielding 1.25% are worth like 52 cents on the dollar. Imagine if you bought those.
Yep.
And a lot of people did, because those were issued right at the heart of the pandemic, right when it kicked off and everybody was at maximum fear and was otherwise invested in like ESG funds. And then all of a sudden they were like, oh no, we've got to go burn coal and buy bonds.
Are you trying to set up blame for our next guest?
Well, we have Michael McKee here.
Okay.
Our international
I just came to
economics-
the 6th floor for coffee, and
Exactly.
you guys.
Our international economics and politics correspondent, and what an amazing ride to see. Almost every day until yesterday, we had yet another high in yields. In fact, I think yesterday the 10-year ticked up to 488.
Yeah, but today
we're back down a
We're
little
down
bit,
a
but we got to we continued making new, like, since 2007 records. What do you make of that? What's that do to the real economy?
Well, I'm sure you've had a lot of guests on, and they all have different answers in terms of why this is happening. But it does seem to be the market basically repricing for a different environment, one in which the Fed's rates are higher for longer. We don't know how long, and for a stronger economy than people anticipated. Now, the Fed didn't get the anticipating the strong economy part right, although they have gradually moved up. But they did get the higher for longer right in a long time ago. They've been telling the markets for this. So everybody finally sort of bought into it. And that's why I think everybody's...
Only sort of, by the way. But by the way, Mike, so we got the dot plot, right? And it shows one more rate hike and then 2 more cuts. Almost everybody I talked to, without exception, said, well, they're just putting that there as a place marker, like a maybe. They're not really going to do it, right? I mean, why do we find it so difficult to believe that when 12 of 19 Fed participants put a dot there, that means they really think they're going to raise rates there?
Well, I don't think they thought they're going to raise rates. They say that basically, if we need to, we will.
I thought that was their forecast for where rates will be.
But no, it's not, actually. And the Fed doesn't like it when you say that. So you're
That's why he doesn't get invited to...
Do we have a timeout corner here for Matt?
No, so Mike, say you're Austin Goolsbee, right? And they're like, your dot plot's due today. So you hand in, as you're Austin Goolsbee, you say, I think rates, the effective rate will be 5.6% at the end of 2023. That doesn't mean that Goolsbee really thinks it's going to be 5.6% at the end of 2023?
Well, he thinks that you're looking at it backwards. It's not that they start with the Fed funds rate. They start with their forecast. Here's what growth, unemployment, and inflation is going to be, and the optimal interest rate for that, if you have those things happen, would be X. it's not a promise. It's not a forecast. It's basically just their math on what they think the number should be. And there's 19 of them, and so you get we look at the mean of the number, and we say, well, this is what the Fed's forecasting. But
Austin doesn't overestimate to jawbone the market, right?
No, but they know the markets tend to overreact to everything. I was talking with the brilliant and talented Ira Jersey just a short time ago, our bond guy. And
Chief U.S. rate strategist for Bloomberg Intelligence.
He pointed out that the rate move is not unusual, that rates often adjust by 40 or 50 basis points one way or another. It's the speed that people are concerned about. And does that mean something? We don't know.
Will it break something as well?
I've talked to a number of Fed officials in recent days who say they think the banks are okay, that they've cracked down, gone in, looked at a lot of banks, and they don't think there's another SVB out there.
Well, this is a sound and resilient financial system.
Exactly.
That's what we've been told.
And so if that's not the case, what else is going to break? I mean, you may have to change the wording of your bond portfolio from income producing to yield harvest or something like that. But, yields probably will go back down again to a certain level. But if we get the kind of economy that it looks like now, where we will be growing at about potential 2%, and the inflation rate comes down, then a 1 or 2% bond yield doesn't make sense. So the market understands that and is pushing back against it. The Fed gets the benefit of that if it helps cool the economy down and achieve their goal.
Yep. All right. Jobs day tomorrow. How does the Fed view this data point here vis-a-vis just the inflation data points that we also get?
Well, they're looking at it to get an idea of whether supply and demand is getting into better balance. If we continue to get a lot more demand, a lot more jobs out there, and people not filling them, then that's a problem. But if people are getting jobs, and at the same time the average hourly earnings aren't shooting up, then that's okay. So the Fed looks at it as a marker along the way. It is part of their mandate, but with unemployment at 3.8%, forecast to go down to 3.7 tomorrow, they're not outside the walls of their mandate on jobs, so that's not an issue for them at the moment.
So wages, is wage inflation, wage spiral, is that still something we talk about? Because now, don't we have wages now above inflation?
Well, economists are not talking about a wage price spiral. A wage price spiral is you get a raise, and Mike Bloomberg raises the cost of terminals to pay for your raise, right? Because you got a really big raise. Of course. And we're not seeing that out there. The companies raise prices because they had to pay more to get people back, and because their input prices went up. Now that's all sort of fading, and wage increases are going down. It's not as big a deal. And we don't have the kind of big contract pattern bargaining that we used to have, where there were 200,000-300,000 employees at each auto company, for example. There's 150,000 in the UAW. It used to be 1 million.
For the big three.
So for the big three. So there is a trickle-down effect, but it's coming down. And so it's not the same as it used to be when we got into that 1970s kind of thing.
I was just going to ask, because, they could, at the end of this, get a 30% increase. Plus, obviously, we could see prices for new cars rise dramatically. In fact, when I ordered my Scat Pack...
The Scat Pack?
Paul,
where is it, by the way?
I believe it's sitting in Brooklyn right now. So when I ordered
this is so far away, you can't go get it?
I'm going to go get it today. They had to update a few systems, and they had to detail the car.
Are you going to bring it to the courtyard and show it off for everybody?
Eventually, I will.
All right.
But the price has gone up dramatically since I ordered it.
You can flip it now.
No. I'm
Drive it a little bit.
I'm not going to let go of it. And I don't think prices are continuing. I hope prices don't continue to rise, just for the good of people who need new cars.
Next Wednesday is CPI. So Thursday is CPI.
By the way, we only have a minute left, but do we have consensus for a soft landing? Because Goolsbee says this is going to be the mother of all soft landings. We're on a golden path, he says. But John Authors points out we're in the middle of a bear steepening, which typically doesn't end well.
Well, there's not a consensus for Austin Goolsbee's view, but there is generally a consensus that we don't have to have a contraction, a GDP contraction, a recession at this point. Now, we'll see how the economy develops. But the interesting thing about the bear steepening is that the yield curve is steepening, which is usually right before a recession, but it's because the long end's going up, not the short end is going down. Usually it's the short end going down because the Fed is cutting rates. And so it's a different dynamic.
By the way, I bring up Austin. I'm only banging on about Austin because he was on Odd Lots.
Well, it's very interesting. You should listen to that.
Yes, all right, Michael McKee, thanks so much for joining us. Michael McKee, Bloomberg International Economics and Policy Correspondent, with our news in New York City. Here's Michael Barr.
Paul, Matt, thank you very much. Florida Representative Matt Gaetz says he supports speakership bids by both Congressman Steve Scalise and Jim Jordan. Gaetz, who put the vote to remove Kevin McCarthy as Speaker, spoke with Joe Matthew and Anne-Marie Hordern on Bloomberg TV and radio about the status of ethics investigations into him.
I am the most investigated man in the United States Congress. I have been cleared by the FBI, the DOJ. The Federal Elections Commission had a 5-0 vote to clear me, and the people who told vicious lies about me 2 years ago are now sitting in federal prison for being part of a criminal fraud scheme to shake down my family.
Meanwhile, moderate House Republicans say they are calling for Gaetz's expulsion from the House GOP conference and punishment for the other 7 Republicans who voted to remove McCarthy from the Speaker's position. Louisiana Republican Congressman Garrett Graves says Tuesday's vote brought out divisions in the House Republican conference.
I think if we stayed in the room last night, and I'm not exaggerating, I think it probably would have devolved into a little bit of physical altercation in there. People are mad.
Secretary of State Antony Blinken stopped in Austin, Texas, on his way to meet with leaders in Mexico for talks on migration and drug trafficking. Blinken says the U.S. has to help develop economic opportunities in the countries migrants are leaving.
If you're a parent and you literally cannot put food on the table for your kids, you are likely to try to do anything to be able to do that. And that includes maybe going anywhere if there's a greater prospect of doing that somewhere else.
Blinken spoke to students at the University of Texas. The issue of the Rio Grande buoy barrier is on the court docket today. A federal appeals court will hear arguments. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Michael Barr, and this is Bloomberg.
Connection lost.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with his Bloomberg Business Flash. NASDAQ 100 right now has fallen more than 1%, session lows for the index there. The S&P 500, that's on pace for its 5th weekly decline today. You worry about a hawkish Federal Reserve. That's mounting after applications for U.S. unemployment benefits that remain historically low. Investor sentiment does remain fragile after we saw wild moves across markets this week. More today, driven by bond yields. Eric Friedman at U.S. Bancorp expects the volatility to ease up.
I'd say that our view is that the economy is still in a good place, not a great place. And so we think that there's probably a incrementally, let's call it modestly positive news is probably enough for the bond market to settle down.
Right now, the S&P 500, 32 points lower. That's down 0.75%. We're at 42.31. The Dow Jones Industrial Average down 129 points, right at 33,000. NASDAQ 100, 184 points lower. Right now, that's down 1.25%. Some of the individual shares on the move. Clorox slumping to the lowest in more than a year. They say the impact from that cyber attack put significant pressure on sales and profit. And since Matt brought this up, Paul, we'll look at the 210s. The disinversion there, now down 29 basis points, negative 29 basis points, the difference between them. The move, though, as Mike McKee had pointed out, has been driven by a fall in the price of the long-dated bonds. We're going to call that a bear steepening. Not necessarily good. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Matt and Paul.
All right, JT, thank you so much. We appreciate it. Matt Miller, Paul Sweeney, live here at the Bloomberg Sustainable Business Summit. We are right at the 6th floor, Bloomberg HQ, 731 Lex. Matt Miller stepping up his game, going from the I just got off the golf course look to I'm ready to go do some power.
You got to be presentable,
for yeah, for TV and for conferences and stuff like
for
that.
YouTube.
Sure.
If you want to see my change of clothing, I just went down to the phone booth.
Yep.
And threw on the suit.
There you go.
You can go to youtube.com and Google Bloomberg Radio to watch us.
There you go. Good stuff. All right, we're starting to get some results from the recent CFA exams, Chartered Financial and Analyst. That's kind of the benchmark for working in financial services. I've always recommended to people that ask me, young people, I say either the MBA or the CFA. Both will get you kind of to a similar place in terms of training. We're starting to get the numbers here. And Catherine Doherty joins us here from Bloomberg News. She's got a story out on that. So we got this level 2 of the 3 levels came out. What did we learn in terms of the pass rates, Catherine?
So level 2 came out today. It was trending slightly lower than the last time that they reported. So the last test takers are coming in around 44%, and that's just slightly below the 45% 10-year historic average. So we saw these levels really dip during the pandemic across all 3 levels. They were starting to come back in the last year or so as people were getting back on track with studying, getting in the groove. But now you're starting to see that after it spiked and was trending in the right direction, coming back down a little bit. But these levels, at least that came out today, don't seem to be a cause of concern. It's more, again, in line with the last decade of the historic average. Level 1 came out earlier this week. That was a little bit lower than historic average. But again, it's not the same dip that we saw really during the height of the pandemic.
Because the pandemic, I mean, I can't imagine studying for these because people don't know. The students they take dozens and dozens and dozens of hours studying for one level. And if you're all discombobulated in terms of where you can study, how you can study, all that type of thing,
Wait,
did
I'm
see it, though.
confused. Isn't a pandemic and a lockdown like pretty much the most ideal situation for studying?
So
you
it's-
can't do anything else.
You're right.
You're not going to
but-
a dinner party. You're not getting hammered with your friends on a Friday night.
But
You're
you
sitting
have,
home studying.
You have to think about this, though. There was a period where tests were just canceled. And so this test, what they recommend is that you take each level in succession because you're building off of what you're learning. And when you're studying for a test also, and there's a disruption, and all of a sudden you've been studying for months, and then your test that you're supposed to take at the end of those months gets canceled, well, you're going to forget all that information, and maybe if you try to pick it up in a few months later when the tests are back and you're able to actually take it, that might throw you off of your game. And that's really what the Institute was saying. They were saying that they were seeing a lot of their test takers come in, and they had really been ready at one point, but then they weren't able to take the test. And then when they started restudying, it was just throwing people off. And we're going to see next year, actually, some even more changes for the test. They've completely rejigged not only the style of how you're taking it, but the actual content is going to change. And
Really? How so?
even the study materials. They've broken it down by specialty. So when you get more advanced, I think it's level 2 and definitely level 3, you can focus on, let's say you want to be a portfolio manager or a wealth manager. And it's as if you can pick your expertise and then
Almost like your major
study.
in an MBA program.
Exactly.
Yep.
And so that's going to be kind of the next shoe to drop is how do students respond to that. But the Institute created and changed the test because of what they were hearing, the feedback that they were getting from actual test takers, some of whom are in the industry now and were saying, hey, this test, sure, it might have given me an opportunity to work in finance, but the skills that I was given, I'm not using in my day-to-day. So they went back and they thought, okay, how can we actually tailor our test so that not only is the skills an indicator of your study habits, it does show that you're a strong test taker and that you work hard, but the skills that you're actually hopefully holding on to, you want to be able to apply it. It's like studying for college, and people say that, okay, well, you're studying just to learn how to study for this test, but ultimately you're not using the material. Well, the CFA is saying we actually want to make sure that our material is reflective of the industry that we hope our test takers are going into.
Right. I mean, otherwise you'll forget everything like you did for level 1 when they moved the test. Just because they moved the test, all of a sudden you forgot everything that you studied for?
Exactly.
That's a problem.
Yes.
Right?
So are more and more people taking the CFA test these days?
Is it getting harder as well? Is it getting more difficult?
Well, it's funny because when the test, when the percentages were dropping during the pandemic, there were a lot of test takers that were even reaching out to me when I would report on these numbers, and they would complain and they would say this test is getting harder. But the Institute was saying, our test we're using the same, we're judging, the content is the same, but what is changing is it's the disruption from the pandemic. It's the timing. It's also the major change was that it went from paper-based, in-person test taking to computer-based. And so some test takers were saying that was messing them up. They were used to writing with their pens and pencils, and then all of a sudden they had to transition to a screen. And that was, that's a difference. And for some test takers, that's going to alter how they perform.
Is it all virtual now from home?
Now it's all not from home. It's still in person, but it's on screen rather than on paper.
Okay, so you go somewhere, a test facility,
test center,
and now just take it online.
And in terms of are less people taking it, the numbers were dipping during the pandemic, and now they're coming back to, I've seen the average get back to on trend. So there was a little over 9,000 that just took level 1, and that could be in the 10,000, or it really depends on the month.
And it used to be just in June.
And
once
now
a year.
Exactly. So that's the other thing to think about is now it's 4 or 5 times a year. It depends on the level. So when you spread it out, you do have, maybe if you add it up, it's the same amount of people, but you can break it into the months or the quarters of the year.
So the most important, I guess, question is, what's the pay bump? For a CFA passed versus a non-CFA in the same job? What difference does it make to the bottom line?
I mean, I think it depends on what type of job you are looking at. Analysts or wealth managers, they might get some pay bump. But what I hear more often is the type of job opportunity that this offers. So if you have someone that wants to pivot in the same way that you mentioned how an MBA would be something that you recommend, people will take the CFA to then go to their boss and say, hey, look, I've demonstrated not only my test taking abilities, but my knowledge base that I've garnered, and I can go into, let's say you do specialize in something like portfolio management. I want to do that.
Yep, absolutely. Great stuff, great reporting. Catherine Doherty, Bloomberg News, bringing us the latest reporting on the CFA results, kind of getting back to a little bit more of a normal situation. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
Thanks, Paul. AT&T is thinking about what to do with its co-ownership in America's third largest pay TV provider. Bloomberg's Courtney Dunninho has details.
AT&T has begun to explore options for its 70% stake in DirecTV. Bloomberg has learned some of the options include adding a new investor or selling a stake and exiting the venture as soon as next year. AT&T co-owns the pay TV provider with a private equity firm.
Now, the current ownership structure could also still continue as is. Shares of AT&T right now up about 0.5%. Constellation Brands is raising its annual profit target after topping sales expectations. But Bloomberg's Simone Foxman says it's not all good news.
Beer income really leading the charge here. Beer sales were up 12% year on year. Most analysts had anticipated a rise of about 10%. But wine and spirits, incredibly weak and much weaker than had been anticipated. Operating income in that segment down 19% year on year.
And that explains shares right now. They are down right now about 2.5%. Conagra, the maker of Healthy Choice frozen meals and Slim Jim meat sticks, says comparable sales slipped in the first quarter, driven by an ongoing decline in sales volumes. Now that's despite a 6.3% increase in prices and a positive shift in the mix of products sold. Right now, Conagra shares are down a fraction. And if you have an overheating iPhone 15, Apple has a solution. The tech giant released a free system update to fix the issue. Apple says the overheating was software related and has nothing to do with its new processor, titanium casing, or switch to a USB-C charger. Those are the company stories we're following this hour. I'm Lisa Mateo. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, Matt Miller and Paul Sweeney live here at the Bloomberg Sustainable Business Summit in New York City. Look at these markets here. S&P 500 off about 0.6%. NASDAQ taking it on the chin here a little bit more, down almost 1%. On the yield front, we see the 10-year Treasury yield just slightly, 4.73%. The 2 years at 5.02%. A little bit of a respite in the decline that we've seen over the last few days in crude oil. WTI crude oil is off about 0.3% here, $83.91 for crude oil. So we got had some big moves over the past couple of days, but kind of a little bit more of a respite today. Right now, let's head down to Washington, D.C. Amy Marsden's got world and national news.
Thank you very much, Paul and Matt. Michael Barr speaking here. GOP Congressman Steve Scalise and Jim Jordan are vying to become the next House Speaker as the lawmaker who triggered Kevin McCarthy's downfall faces new opposition. Moderate House Republicans are pushing to expel Florida Representative Matt Gaetz from the House GOP conference and punish the other Republicans who voted to remove McCarthy. New York Republican Congressman Mike Lawler.
This wasn't a policy difference. This was personal. These folks put their own personal and political interests above all other considerations. They undermine the conference, they undermine the institution, and they undermine the country.
Lawler says we need to elect a new speaker because of their selfish deeds. The Biden administration announced that they have waived at least 26 federal laws in South Texas to allow continued border wall construction this week, drawing criticism from Democrats and environmental activists. The Department of Homeland Security is waiving dozens of laws and using funds that Congress already approved in 2019 specifically for border wall construction. Critics say this will be ineffective and bulldoze through endangered habitats. Rudy Giuliani has filed a defamation suit against President Biden in New Hampshire. Bloomberg's Steve Rappaport has the story.
The former New York City mayor and associate of former President Trump says then-candidate Joe Biden defamed him on the campaign trail during a debate in 2020.
What he did to me is intolerable. He called me a Russian operative.
Giuliani is heard on WMUR TV adding that is a lie and false. An attorney for Giuliani says he's allowed to recover damages in New Hampshire because the debate aired on television there. In addition to financial compensation, Giuliani wants a judge to order President Biden to publicly acknowledge the allegations. Steve Rappaport, Bloomberg Radio.
And finally, you can turn your nose up non-lottery players, but if you hit this jackpot, you'd be making a money for two. No winner, again, for Wednesday's huge Powerball lottery jackpot. And that means Saturday's drawing is estimated to be $1.4 billion with a B, dollars. And if you're thinking, Barr, you are wrong, I'm going to check my tickets. Well, here are the numbers. 9, 35, 54, 63, 64 with a Powerball of 1.
Oh, my gosh.
You got the 1. No. Global news, 24 hours a day, powered by more than 2,700 journalists and analysts, over 120 countries. I'm Michael Barr. This is Bloomberg. Paul, Matt, John.
All right, Michael Barr, thank you so much. We appreciate that. Used car prices are falling, and that's a problem if you've got debt associated with those used cars, because that amounts to negative equity. The amount that debt exceeds a vehicle's value, that's been climbing. It was $5,820 in September. That's compared to a low of less than $4,100 in 2021, Matt. So used car prices finally coming down, but not for your Challenger Scat Pack thing.
Well, I mean, look, here's an example. I bought this car. I'm buying it today, right? And there is a 2-year-old used version of the exact same car sitting at York Chrysler Dodge Jeep Ram in Toledo, Ohio. York. That's the name of the dealership. Nice. Y-A-R-K. Anyway, it's a gorgeous vehicle, and it's only got like 3,000 miles on it. I think a little bit less than that. And yet, it's only going for $3,000 or $4,000 less than I'm going to pay today.
Okay.
So, you know, typically cars depreciate by 20%. In this case, not even 10.
Right. All right. Very good. I'm leasing mine. That's kind of how I roll back to that. So I get a new car every 3 years is the way I like to look at it. But used car prices coming down a little bit. They were surging during the pandemic. We'll stay on top of that because we like cars. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
We got a lot of green on the screen here, but the volume is light.
We constantly underestimate the strength of the U.S. consumer.
This is a market that's much more optimistic or bullish than maybe the central bankers are.
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
The supply chain has still got dislocations globally and here in the U.S.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, coming up in this hour, we're going to check in with Abigail Ross Hooper, President and CEO of the Solar Energy Industries Association. Talk a little bit about solar energy. We got the sun come streaming in right now, so we can attest to that here in New York City today. And then we're also going to check in with Shaheen Contractor, our old buddy, ESG analyst with Bloomberg Intelligence. She's going to join us to discuss this Bloomberg Sustainable Business Summit that we are at and her presentation today that she's making at the conference. But first, let's kick things off, get a sense of what's happening in these markets, and John Tucker.
What is happening, and it's not good. NASDAQ 100, Paul and Matt, right now leading the declines in the major averages. It is down right now 1.25%. The risk-off move being fueled by the latest data that shows weekly unemployment claims near historical highs. So that suggests the Fed may have to keep interest rates higher for even longer. Some of the big laggards in the NASDAQ 100 include Microsoft. That alone counts for about 9 of the index points. That is down 1.1%. Jens Nordwick at Exante Data has deep concerns about the economic toll of the higher for longer interest rates, meantime.
These higher yields are starting to spread into credit, starting to spread into risk assets, right? So we had having a big kind of risk reduction wave here over the last couple of weeks. It's not like a total panic, but it's broad-based.
And now traders are looking ahead to more data. So we're going to get the payrolls data tomorrow with a big jobs report. Next week's inflation data number, that could decide whether the 10-year Treasury yield goes up to 5%. Of course, that would weigh on risk assets. 10-year right now, 472, pretty much unchanged. The 2-year is down 2 basis points, 5.02%. The 30-year, the long bond, that's up 3 basis points. That's at 489. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Matt and Paul.
All right, John Tucker, thank you so much. We appreciate it. We're live here at the Bloomberg Sustainable Business Summit. Matt Miller and Paul Sweeney. We're also streaming live on YouTube, so you can head over to youtube.com and search Bloomberg Radio. And the sun comes streaming in. We are blinded by the light, literally.
First of all, fantastic song.
Yes.
What, who, is that Kansas? Who? Supertramp? Who Blinded by the Light?
That's a Bruce Springsteen.
Is it?
Yes, he wrote it. But the I can't remember who made it number one. It wasn't Bruce.
All right. So, but this is all part of, yes, we're being blinded by the sun from behind and the huge spotlights in front of us.
Yep.
This is all part of being an internationally broadcast star.
That's what
we're, this is
how
what
we roll.
It means to be famous. You've got to deal with these uncomfortable situations. This is what we do for our fans.
Exactly. We just go anywhere. We're on the road here on the 6th floor. Manfred Man. Thank you, Bob Bragg.
You can go to youtube.com and search Bloomberg Radio and join the literally dozens of people who are watching us live.
I think it's more than that. And Manfred Mann took the Bruce Springsteen song "Blinded by the Light" and made it, I think, number one. So
does he say "wrapped up like a douche in the middle of the night"?
No, wrapped up like a deuce.
Oh,
my gosh!
I've always misunderstood that.
There you go. Wow. Jess, that's a great intro for our next guest.
Here we go.
All right, we got stocks trading down 0.7% on the S&P 500. It just kind of feels a little heavy out there, Jess. What individual stocks are you looking at?
Yeah, well, I actually wanted to point out, so I did today's Taking Stock column. I was taking a look at small cap stocks. So you're looking at the Russell 2000, ticker symbol RTY. I actually was looking at it relative to the S&P 500 on an annual basis. So it's on pace for its third consecutive year of decline. So we talk so much about small caps. It's not necessarily just this year or in recent months. I mean, this is a particular group that's been under a tremendous amount of pain for a number of years now. So when people like to focus on them,
as rates have been rising.
Yes, because more domestically focused, they typically hold more debt. So obviously, as the Federal Reserve raises rates, that's going to impact them more so. They don't have as much, if you're thinking about obviously the bigger, larger cap stocks in the S&P 500, like the multinationals, that obviously can derive those revenues from overseas. So clearly they have been among the most hardest hit since this Fed rate hiking cycle, and even before that. So they typically bottom before large cap do. So that's why people like to focus on the direction of them and what they tell you about the economy. So the question, and it's a fierce debate about whether or not most of that pain is already there or not. And I was actually talking to Liz Ann Saunders at Charles Schwab, exactly, and she's on Bloomberg, obviously, radio and TV often. And she was talking about just the level when it comes to the amount of zombie companies, when it comes to small caps. And T. Rowe Price actually had a recent note in the last month talking about they're basically at an all-time high. So she felt like when it comes to a lot of those types of smaller companies that just aren't generating enough of revenue and really being able to support themselves, they kind of need to be weeded out for that to see that. But then you also see a big difference between, say, the Russell 2000 or the S&P 600 as far as how
Which is
the
what,
representation.
more mid-caps?
Well, you do have the 400 would be more mid-caps, but when you're thinking about, the 600 too, the sort of differential when you're thinking about from a profit perspective and the earnings perspective as far as them holding up a bit better than, say, some other companies that are in the Russell 2000. So you do see differences.
What are the limits on, so do they define that purely by market cap, whether you're small, mid, or?
Right, exactly. So usually if you're going to be more of a larger cap type company, you're going to be over, what, 2 billion and more than that. And then so when you're smaller, obviously in mid cap, you're going to be below those types of thresholds. But actually, interesting enough, when you look at where the Fed funds rate, and this is some data I'm sure Paul would be excited about from Bloomberg Intelligence. So Gina Martin Adams, Michael Casper over there, they were looking at the Fed funds rate versus where the price to sales ratio is for the Russell 2000. It's not anywhere close where it would have been, say, right before the hiking cycle that would have begun before the great financial crisis. And so in that way, you could view that, well, maybe potentially there is more pain to come, but then there's also some contrarian indicators when you look at high yield spreads. And usually when they peak out, that tends to historically bode well for small caps, and they have peaked out. So it's the debate's there as far as how much more pain.
But you're saying there are people who think small caps have bottomed here.
Yes.
And I wonder how many of those stocks are in, since we're at the Sustainability Summit.
Sure.
ESGU, which is the biggest ESG, I guess, ETF, whatever that means. We've seen outflows for 4 of the last 4 quarters. So investors are aggressively selling out of the whole sustainability investment thesis.
In the U.S.
In the U.S., and I guess...
It's still raging positive.
I haven't looked at the data. I haven't looked at the data, but I will ask Eric Balchunas about that. I just know that here, it seems very correlated with rates. So as rates rise, people are like, I'm getting out of ESG.
I disagree.
I'm getting out of small caps.
I think it's just political.
Do you?
I do.
Oh, you think it's sort of political backlash?
Yes. I think that's a big driver.
But you have people polarized on both sides. So in that case, it would be split.
I think the net buyers were buying over the last several years, and I think the marginal buyer gone.
Interesting.
So actually, when it comes to small caps in particular, they're more heavily weighted toward financials, energy, and when you overlay that...
For example, and Balchunas was saying the same thing about ESGU. He said, well, he sees a correlation with rates because these are energy and in some cases value stocks as well, you know.
And that's why they don't have as much exposure to, say, like tech and so-called like growth stocks. So you're not going to see those types of benchmarks hold up as much as, say, some of their larger counterparts this year. And actually, interesting enough, if you overlay and you look at what the S&P 500's financial sector is doing compared to what the Russell is doing, it's very similar if you look at where they peaked out. If you can do kind of an overlay in the terminal of those, and they're both close to retesting their pre-COVID highs. So that's something else that a lot of my sources have been keeping a close eye on as far as what that could mean for the broader market, and that they can just hold that support
Jess,
there.
with regards to the broader market, nothing matters more than the rate spike that we saw. I mean, unbelievable. The 10-year going up to 488.
Yeah.
Right? And we were talking earlier about 30-year bonds that were issued in 2020 losing half of their value. It's not typical that you buy treasuries and think, I might lose half of my capital in the next 2 years. Right? So how has that affected this market?
Well, also you see the amount of money going into money market funds since the low of last year. If you look at from the low to now, it would be actually over $1 trillion into money market funds, which is a record. So you're still seeing that rate dynamic play out into money market funds. And then obviously there's always cash on the sideline, so that's not necessarily anything new. But the question being, when you have that as such a record, at what point does that money come out and go into equities? But the catalyst is still what's happening in the yield space and how, what's going to take to really change that.
Yeah, the TNET trade is gone.
Yeah.
I mean, now there's lots of places to put your money. Jess Menton, thanks so much for joining us. Jess Menton, she covers all of the equity stuff for the Bloomberg News, and she's got a big football game. Her Texas A&M Aggies go up against Alabama.
Be good.
So that's going to be fun. We'll watch that. Nice. It's going to be a marquee game. Yeah,
we're all Aggies.
Oh, we're all Aggies
this weekend.
Yes, I love that. Thank you.
Exactly. All right. All right. Looking at these markets, I kind of got that sell-off kind of continuing out there, and we've kind of got the S&P off about 0.8%. The Nasdaq off 1%. So a little bit of a rollover here today. The jobs data tomorrow will be big.
Jobs data tomorrow, and I really think this yield spike has spooked.
Yes.
Markets.
Yes.
Across the board. Okay, it's come back down a little bit. What are we looking at right now? Like 4.7%?
On the 10-year, we're looking at 4.73. Yep.
So right about where we were yesterday, so maybe not a heck of a lot of movement in the last 24 hours, but that spike, I think, really freaked people out because the question is, does it break something? Is it problematic if you start getting 30-year yields at 5%?
And I did see that bond due 2050. John was absolutely right. It's at 40.70 right now.
47 cents on the dollar.
Exactly.
Unbelievable. I mean, you feel like, okay, I'm investing in the safest asset there is. I get it. It's long duration.
Yep.
But, man, you don't think you're going to lose half of your principal in 2 years.
No. All right. We got sun beating down on us, right? Coming through the window here at 731 Lexington Avenue.
We should use it.
We should perfect time.
What a great way to make energy.
Let's put up a solar panel.
Yes.
Let's put up a solar panel. Let's talk solar energy. Abigail Ross Hooper joins us. She's the president and CEO of the Solar Energy Industries Association, SEIA, for the folks in the know. Abigail, thanks for joining us here. Talk to us about solar energy. I gotta think it's a big beneficiary of the looking at the
green transition.
Yeah, the green transition, the Inflation Reduction Act.
Right? We've seen peaks and troughs in terms of investor interest, but I'm sure the amount of panels out there just continues to grow to record after record.
Yeah, I mean, first of all, it is hot right here.
Yes.
Okay,
Yes, true.
So let's just have a moment. It's working.
Yes.
Okay, if anyone wondered, the technology works.
The sun works.
The sun works.
Global warming feels real.
It's really real right now. Yeah, it is a pretty exciting time to be in the solar industry. Our projections tell us that this year our industry is going to grow by about 52%, which you were talking about something growing at half. As I was walking up here, we're going to double, which is an exciting. It's pretty.
We were talking about 30-year treasuries.
Yeah.
Typically a very safe investment.
Yeah.
Has been a bad bet over the last 3 years.
Not so exciting. So solar is going to the installations.
Well, what
52%.
about the backlash that Paul has been talking about? It's become a very political issue, ESG in general, the green transition, obviously. And even though we probably see more solar panels in Texas than anywhere else in the country, you've had, especially those people down south, like really pushing back against ESG.
Yeah. So that's why you're never going to hear those letters or those come out of my mouth. But you know what you are going to hear come out of my mouth? Lower prices.
Yep.
Because yes, it is true that California is the state with the most solar in the country right now.
Okay, so California has more solar than Texas.
Texas and Florida are 2 and 3.
Yep.
And over the course of the next few years, it's really a race for which one's going to be number one. Texas and Florida are not known for their big D politics, right? But what they are known for is wanting the lowest energy prices and competitive energy markets. And so that's really why people are going solar. And when I say people, I shouldn't say people. I should say customers.
Yep.
And customers are utilities.
Yep.
Customers are corporations, and customers are homeowners, right? Apartment owners, warehouse owners, utilities, co-ops, kind of anyone that wants low energy prices, which is pretty much every person and every company in the United States.
Can you talk to us about the efficiency of solar energy versus the other sources and kind of how that, I guess, maybe the return on my investment works?
Yeah. So you sort of asked two different questions. Like, of breaking news, you guys, the sun does not shine 24 hours a day, okay? And so if your only source of energy is you unplug from the grid and you do not have any kind of backup power, you're not going to have power 24 hours a day. So you have two choices. You can either not unplug from the grid and rely on your electric distribution utility for the other hours of the day, or you can have a backup battery system, or you can have some combination of those. So we talk about the efficiency or sort of the capacity factor of a solar system being about, somewhere between 20 and 30%. But that's like a known feature. That's not like shocking news. In terms of your investment, it's a payback period, right? Yep. Like and it depends on what your energy prices are. So the payback period in where are we now? New York?
Yep.
Yes. Your energy prices are a tad bit higher than Wyoming, right? Yep. Or than South Dakota. And so your payback period is going to be shorter because your prices are higher than in those places. So it might be 7 years here. Mm-hmm. It might be more years in a lower cost place. It depends a lot on...
7 years is what the payback for, you're talking about, I guess, the average family putting solar on their roof.
If you put solar on your roof, exactly. Lots of factors, but that's around-ish.
But how is solar power viewed versus wind, nuclear, gas?
So interesting. You can't actually put wind usually on your home, and you can't have your personal nuke power, right? So
you can if you live in South Dakota.
True. And you ask the SMR guys, right? They're going to tell you can have your own personal SMR. But solar is unique in that you can have your own, like it's scalable in a way that a lot of other technologies are not. But utilities, right? They have a choice of different energy prices or energy technologies. Solar is the number one new energy source in the country, and it has been for the last few years. So utilities that are putting out RFPs for new energy sources.
What are RFPs?
I'm sorry. Request for proposals.
Yeah. I see.
So they're saying, hey, we have new load. We have new customers. We have new towns that are being built. We have new subdivisions. We have new electric vehicles. Like we are retiring some assets. We need new capacity to fuel our system. So we're putting out a request for proposals to build some new electricity. So who's the best option? And they'll get a whole bunch of different proposals. And over, they are choosing solar and building solar because it's the lowest price and it's making the most economic sense for their customers.
I guess, is easier in places like South Dakota or Texas, right, where there's just so much space.
There's a lot of space.
You're not going to build a solar farm in Westchester County, for example, because everybody's like right next to each other.
The good news is the Princeton campus for Bloomberg has a massive solar arrangement down there. And panels everywhere.
So does Denison University's campus.
Nice.
I was just looking at it in Granville, Ohio.
But your version of massive, Texas's version of massive are a little different.
You're exactly right.
So do you still see growth in those big, massive solar farms?
Yes. So the massive version in the West is like...
thousands of acres.
Thousands of acres.
Yeah.
The massive version in Westchester
it's a couple acres.
is some acres.
All right, Abigail, thanks so much for joining us. Abigail Ross Hooper.
Hopper.
I'm sorry, I had the typo here. President and CEO of the Solar Energy Industries Association, bringing us up to date here on the powers of solar energy. We're going to have more coming up. This is Bloomberg. Thank you very much.
Good morning. British Airways reached a tentative labor agreement with unionized pilots. The carrier says members of the British Airline Pilots Association will now vote on whether to ratify the agreement. Now, it builds on pay and working condition changes made last year. Parent company IAG announced better than expected second quarter earnings back in July. Shares of IAG right now, they're up about 2%. And electric vehicle maker Rivian is looking to borrow more money, announcing plans to issue $1.5 billion in convertible debt. Bloomberg's Isabel Lee explains.
These green senior convertible notes due in 2030 are private offerings to qualified institutional buyers. And Rivian also is extending an option for buyers to purchase an additional $225 million. So the bond issuance, of course, could dilute the current shareholders' interest. But Bloomberg Intelligence is saying that the timing makes sense. But this, of course, comes after Rivian has disappointed investors earlier this week when it maintained its full-year guidance of 52,000 battery EV vehicles this year.
Now, Rivian releases its earnings on November 7th. Shares right now taking a hit, down nearly 20%. Hyundai and Kia EVs will be able to use Tesla superchargers. The Associated Press reports they're adopting North American charging standard ports for their electric vehicles in the U.S. and Canada. The superchargers have been popular with other automakers because they have more direct current fast charging plugs in the U.S. than any other network. And at stations, they're also in prime locations. Both brands will come out with the NACS port in the U.S. in the fourth quarter of next year. Right now, shares of Hyundai down a fraction. Tesla right now down about 1.5%. Those are the company stories we're following this hour. I'm Lisa Mateo. This is Bloomberg.
stocks, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. We have technology, also some consumer stocks taking it on the chin today. The NASDAQ 100 down over 1%. You have Microsoft, Amazon, and PepsiCo, the laggards right now in the index. 30-year bond yield, that's rising up 2 basis points right now. You did have a data today that suggests the Federal Reserve may have to keep rates higher for longer. Jobless claims data this morning remaining historically low. This may affect risk assets. Just crossing the Bloomberg, Russia will deploy nuclear-powered missiles soon. That's according to President Vladimir Putin being quoted. S&P 500, 32 points lower. That's down 0.75%, 42.31. The Dow Jones Industrial Average, 151 points lower. That's down about 0.5%. The NASDAQ 100 down 170 points. That is a decline of 1.2%. Matt and Paul, I do have to do a correction. I'm sorry. The lyrics from the song are revved, not wrapped, revved up like a deuce. The deuce referring to the 1932 Ford Coupe. I'm surprised you didn't get that car, guy. Yes, revved up like a deuce.
I should have known that. So we're talking about the Bruce Springsteen song Blinded by the Light, which was recorded and really made famous by Manfred Mann's Earth Band.
Correct.
I've always thought he said wrapped up like a douche in the middle of the night.
No.
My whole life. And I'm 49 years old. And I love the song. It's a great song. You're right, John Tucker. It means revved up like a deuce. I just looked up the lyrics. That is a reference to a deuce coupe, a little deuce coupe.
And that correction comes to you from John Tucker, a New Jersey native, Jersey Shore native, a de facto neighbor of Bruce and Bon Jovi down there.
I'm pretty impressed, actually. I'm going to go back and re-listen to that song.
There you go. Okay. Bruce said this is his bizarre song.
Now, initially, it was Cut Loose Like a Deuce, another runner in the night. But Manfred Mann changed it to Revved Up Like a Deuce.
Well, you're just a font of knowledge.
Well, I just Googled it. So.
All right. We're live here at the Bloomberg Sustainable Business Summit here in Bloomberg's HQ in Midtown Manhattan. We're also streaming live on YouTube as well. Let's talk a little ESG. What companies and sectors are most favored by ESG fund managers? To do that, we turn to an old friend, Shaheen Contractor, ESG analyst with Bloomberg Intelligence. She's here at the conference.
You're still using that acronym in your title?
Pretty much. Not
Isn't
going
it?
anywhere.
You're not going to change it?
Nope. Defined.
What is an alternative title?
People are tending to break it up. So sustainability, climate, social, not one.
No one cares
thing,
about governance.
Governance,
obviously.
sorry, no people care about governance.
So, but I was just wondering because I looked at ESGU earlier, which is the biggest sustainability ETF, and it's just seen outflows like nobody's business.
Yeah, so ESGU saw about 7 billion in outflows in the first half of this year. What's interesting is that most of it was on one day, so 4 billion came out on one single day, and that to me is just concentration risk. It's, model portfolio changes.
I looked at it quarterly and it's seen outflows in the last 4 quarters in a row.
Again, same investor likely.
Every quarter that investor just sells.
I mean, do we know who that investor is?
It's probably
BlackRock.
Yeah.
Okay.
So it's model portfolio changes,
I thought
right?
BlackRock was an ESG champion.
Right, but a lot of it is also driven by model portfolio changes, right? Suppose I don't want an equity strategy, but I want fixed income. I end up selling my equity funds and buying into fixed income.
So the reason I looked it up, though, is because I wanted to validate the feeling that we get, which is that there's a huge pushback against ESG.
In the U.S., let's be clear.
In the U.S., I don't think any of us knows what's happening in Europe.
We do know because we have ESG analysts. Yes, exactly.
Is there really this pushback, or is that just the zeitgeist right now? I only measured it in terms of ESGU, but there's a million other ways to measure it.
There is a lot of pushback. So the one thing I would say is I don't think the outflows due to the pushback, but the lack of positive flows is definitely, I think, part of the pushback. In other words, we need a wider investor base, right, when it comes to ESG. And what I think the pushback is going to do is it's going to sort of pause more positive inflows coming in over time, at least while the pushback lasts.
So when does it turn around? I mean, we've just been through, I've got to imagine the hottest summer on record.
It's
right
not
now,
summer
the sun
right
is
now,
just
but
beating down on us,
Yes.
and for that I blame Sarah Livesey. But but we've just been through months and months of record heat. I mean, clearly global warming, as hated as that phrase is upon us, right?
Yeah.
So when do we get people buying into the green energy transition? Is it just too expensive right now?
No, I think the pushback is more along the lines of ESG. I feel like climate is a little better, for lack of better words. It's more around the phrases. It's more around the lack of transparency into, what is an ESG strategy? What does this data actually mean? You said ESGU, so I ask, if it's ESGU is a very sort of benchmark hugging fund, what is the ESG I'm getting? That's more the pushback that we're seeing.
What are ESG fund managers buying today?
We analyzed the largest holding of ESG funds, and we found that a lot of them were in resource-light sectors, so think tech, finance, while they tended to avoid the sort of the resource-heavy sectors like utilities, energy. I mean, I think we all know that, but I don't see ESG as a sector play, so...
What do you see ESG as?
I mean, it's within a certain sector, what are your leaders and laggards based on how they're managing ESG risks or opportunities?
All right, talk to us about Europe and other parts of the world and ESG fund flows.
Sure. So Europe has actually seen ESG flows in ETFs pretty much on pace with last year. It's actually might be a little more.
So
in the
still
first half of this year.
inflows.
Still inflows.
Every quarter.
Every quarter. And still on pace, very much on pace. So that's definitely not seen too much of a backtrack, I guess.
Yep.
It's really the US that has pulled down global ESG ETF flows.
All right, so, but, I mean, the whole point of this thing for us here is to make money, right? I mean, saving the planet is like a nice thing to have.
Right.
Secondary, though. Where can you make the most money in ESG?
So I think...
Especially if there's been outflows,
There's been
Shaheen,
outflows.
you got to imagine that means prices are down.
Correct.
And it's a great
It's
time to
undervalued.
buy when prices are low, because then you can sell when they're high. That's the whole game.
Yeah.
Is that it? Yeah, okay.
Yeah. So I see ESG not as this short-term make money thing. I don't think that's what it is.
Right.
I think it's more this long-term game of, if there are certain risks and opportunities that are non-financial in nature, you should at least know about them. For example, if, say, Facebook has poor shareholder rights, such that when the stock goes down, you can't do anything about it, that's a problem. So it's just about knowing more information to prevent risks and create opportunities long term, not like, oh, tomorrow, clean energy. It's not that.
And Facebook has bad shareholder rights.
Yeah.
Yeah, bad governance there.
Well, I mean, there's a million companies that have dual. I mean, I've covered the media industry for 30 years. Almost every media company has had
Dual share class,
super voting stock.
Super voting stock.
Now, that was for, back in the days of newspapers and magazines, for editorial independence.
Well,
to-
think about
to
how many
ensure-
CEOs also have the chairman role.
Yes.
That's not good governance.
Tech companies have.
And all the big banks.
Yeah, particularly.
All right, so what's the key theme here, do you think, at this summit today, from your perspective?
So I've heard a lot about climate and clean energy. I was at the networking at breakfast, and 4 out of 5 people I met were clean energy people.
Okay.
A lot of themes around the IRA, around regulation and policy coming in and creating incentives.
I mean,
for
the
the
Inflation
space.
Reduction Act is just massive for all that stuff, right?
So a lot of the discussions that I've been in are around that.
Has money started flowing yet?
I haven't been tracking that too well, so I'm not sure yet.
The payouts in the IRA.
Yeah.
But we're talking about
A lot.
more than $1 trillion here. Is that, do you view it as a good piece of legislation?
Yeah.
Because when we talk to European leaders in here, they're a little bit, I think rankled is the right word. They're rankled.
Okay. So
word.
I think I do. So we just had an IRA panel maybe a couple of hours ago, and there was a poll, and it said, what are the benefits of the IRA? And the highest one was job creation, which I think is important for Americans. They value that. And the second one was cost savings. But it was interesting that job creation ranked higher than cost savings.
Okay, so what's the next thing? Like, what are you looking forward to for the rest of the day here?
So I'm looking...
You have a panel.
I have a panel. I'm looking forward to my panel.
All
I
right,
should
what's
say
your
that.
panel? Tease your panel.
My panel is around my favorite thing, ESG ETFs, and sort of painting a picture of market direction, things we spoke about.
What are the other big ETFs other than ESGU?
SUSL, DSI, sorry, I'm naming tickers because
That's how we talk in ETF
Okay, that's
world.
good.
Yeah.
So a lot of the BlackRock ones, Vanguard, two of Vanguard's funds are pretty big. Those are the big ones.
But they're all active, right?
No, they're passive.
Yeah, interesting. All right,
One is
Shaheen.
active.
Shaheen Contractor, thanks so much for joining us. Shaheen Contractor, ESG analyst with Bloomberg Intelligence. Of course, we are live here at the Bloomberg Sustainable Business Summit, brought to you by Ecolab Water for Climate. When businesses reduce water use or increase efficiency, they can save energy while reducing emissions and costs. More at ecolab.com/water for climate. Matt, have EVs become politicized? I haven't heard that.
Oh,
angle.
they have most certainly become politicized.
Really?
I spend a lot of time in, car owner forums.
Yeah.
So I'll go on Bimmer Post to read about what's going on in the world of BMWs, people who own BMWs, or I'll go on Challenger Talk to see what people are thinking about Dodge vehicles or the Mustang 5G forum, whatever. You can definitely tell someone's politics by how long and angry the rant against EVs is, and they'll couple it with conspiracy theories and the deep state, for sure.
There you go. It's everywhere, I guess. All right, with our news in New York City, here's Michael Barr.
Thank you very much, Paul and Matt. As the jockeying for the gavel ramps up, this week's toppling of Kevin McCarthy as House Speaker may have ramifications for the man who led the charge. Several Republicans are openly talking about retribution, kicking hard-right Republican Matt Gaetz out of the House GOP conference. New York Republican Congressman Mike Lawler says the 8 Republican representatives behind McCarthy's ouster should be held accountable.
This wasn't a policy difference. This was personal. These folks put their own personal and political interests above all other considerations. They undermine the conference, they undermine the institution, and they undermine the country.
Meanwhile, Gaetz spoke about wanting change with Bloomberg's Joe Matthew and Anne-Marie Hordern.
My mission is to ensure that the House of Representatives runs better, because the way we've been running Washington, D.C. for the last 30 years has led us to a point where no one is really responsible for the spending. We are backed up against shutdown politics. We are governed by crisis. And the biggest problem is lawmakers have to take one up or down vote on continuing resolutions and omnibus bills to either fund or not fund the entire government.
You can hear the full conversation with Gaetz on the Bloomberg Talks podcast. At least 50 civilians have been killed in a Russian rocket strike on a village store in eastern Ukraine, one of the deadliest attacks in recent months. Today's attack at a shop and cafe came as Ukrainian President Volodymyr Zelensky was attending a summit of around 50 European leaders in Spain to drum up support for the country's allies. The Nobel Prize in Literature has been awarded to Norwegian author Jan Fosse. The secretary of the Swedish Academy in Stockholm says the prize is Fosse's innovative plays and prose. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Michael Barr. This is Bloomberg.
stories, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. The latest data showing weekly unemployment claims holding near historical lows. That's helping push risk assets lower right now. The NASDAQ 100 down over 1%. S&P 500, that's on pace for its fifth weekly decline. The recent rout in bonds, that's been historic. So that has been spooking stock investors that the Federal Reserve is going to have to raise rates even higher. September marking the fifth straight month that yields rose. And Joanna Kirkland at Schroeder Investments says Treasury yields are near where things could actually start to break.
What could get more concerns about recession? I mean, if we start to see somewhere in the system, like we saw early in the year, March, with this kind of sell-off in prices, typically someone somewhere is hurting. Had the smaller banks in March struggling because of this move in yield, so, that could be a concern.
But right now, the S&P 500, 28 points lower. That's down 0.7%. We're at 42.35 of the index. The Dow Jones Industrial Average, 147 points lower. The NASDAQ 100 down 145 points. That is a 1% decline. And using a health database, researchers are now saying that Novo Nordisk drugs that are commonly used for weight loss, like Ozempic, were linked to a higher risk of bowel obstructions and other gastrointestinal side effects. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Matt and Paul.
All right, John Tucker, thank you so much. We appreciate that. We are live at the Bloomberg Sustainable Business Summit, brought to you by Ecolab Water for Climate. When businesses reduce water use or increase efficiency, they can save energy while reducing emissions and costs. More at ecolab.com/water for climate. Matt Miller and Paul Sweeney live here at the 6th floor link at our Bloomberg HQ in New York City. We're also streaming live on YouTube. Just head over to youtube.com and search Bloomberg Radio. That'll get you where you need to go. You want to bring in Barry Ritholtz? He's lurking somewhere. Not here. I think we got him.
Is he
via the Zoom thing?
Via satellite?
Yeah, coming from
Barry Ritholtz joins us. He is the founder and the boss at Ritholtz Wealth Management.
He's got the name on the door.
He also is a contributor to Bloomberg, and he has the Masters in Business podcast, which is very popular. I think it may be our most popular podcast.
Yeah, it's big. And it's because he gets, one of the reasons is because he gets great guests. And I was walking by the studio a couple of days ago and boom.
Michael Lewis.
Yes.
Seriously?
Yes.
I don't know how I missed that. I may have.
One of my favorite books of all time.
He's written many of my favorite books. Liar's Poker, obviously, is what made him famous and is probably... It's one of the best sort of Wall Street reads for new kids coming to the market, right?
Yep.
I mean, Liar's Poker, Barbarians at the Gate.
Yep.
Those are probably the two that I would single out. But obviously he wrote Moneyball as well, which Brad Pitt and Jonah Hill made into an awesome movie. The Big Short.
Yep.
And now he's written a new book.
Sam Bankman-Fried,
I think Going Infinity or something like that, about Sam
Going
Bankman-Fried and FTX. Going Infinite. All right, Barry, welcome to the program.
Thanks.
Going Infinite.
The Rise and Fall of a New Tycoon is the subtitle.
And you have actually read the book. So you know what's in it. And the reason I make that point is that a lot of people who haven't read the book are very angry that he doesn't, lambast Sam Bankman-Fried for being the greatest evil con man this world has ever known. So tell us about the book.
Yeah, so first I had to sign probably the most aggressive NDA I've ever signed, probably because those are the terms 60 minutes. Hey, we'll give you 2 segments to talk about this, but nothing can, we have to be first. So 60 Minutes was first.
60 Minutes, the popular news program on Sunday evening, and they had
CBS.
a big piece on the
and
book.
then we're second. We had Michael, and I think this is like the 6th or 7th interview I've done with him on all of his books and his podcast. And so I got the book, I don't know, it's like a week and a half ago, and read it. Normally, I like to slowly slide into a Michael Lewis book because they're always so delightful. But this one I just banged through really quickly over the weekend, and it's a typical Michael Lewis book. Crazy circumstances, wacky characters, everybody, a little bit off, slightly away from the normal spectrum or wherever you want to put people, just not your norm. And it's fascinating, and it's not at all what I expected. This is just a wild and crazy story, which is kind of shocking because after the 60 Minutes interview, during the 60 Minutes interview, Twitter just lit up. Are you kidding me? This guy has jumped the shark. Michael Lewis is canceled. Only
But why?
not so
Why?
much.
But is the concern that he gave SBF a pass?
When I sat down to speak with him, so the day before the interview, I posted a question on Twitter. Hey, I'm sitting down with Michael Lewis tomorrow. What sort of question should I ask? And, once I sifted out the really, horrific ones, there were a lot of interesting ideas. And the question that people, a few people asked, what did FTX pay you for it? He just laughed at that. No, Michael Lewis doesn't get paid by his subjects to cover them. What Lewis said was, I didn't want to reach a conclusion. I wanted the reader to draw their own conclusion. Was this guy incompetent? Did he have no business managing a $100 billion firm? Or was he on the spectrum of fraud, closer to Bernie Madoff than someone who's just, a bumbling fool? And, you can make an argument either way. Lots of stuff was done that shouldn't have been done, starting with FTX didn't have a bank. So if you wanted to transfer an account into FTX, you could transfer in-kind Bitcoin directly to FTX, or what was banked was Alameda Research, the hedge fund that predated FTX. They had a bank account. So lots of people sent cash to Alameda, and they're supposed to move that cash over to FTX, which apparently they didn't do for about $8.3 billion, or maybe it was $8.6 billion worth of assets. So clearly there's commingling of funds, which is a big no-no. Although, again, this is an Anguilla company operating in Hong Kong,
in crypto,
in Bahamas,
in
which
crypto,
is
by the way,
really
Barry. So a lot of crypto organizations were doing, it seems, commingling of funds, right? And a lot of them went bust. FTX wasn't the only one; it was just the biggest. And because of the kind of interesting and weird, colorful character of Sam Bankman-Fried, plus he comes from such trustworthy parents who maybe helped him along the way. Very famous, intelligent, left-wing intellectual lawyers at Stanford. I mean, just what
experts in legal ethics.
Character.
That's the even crazier part.
Exactly.
Right? So
he was also, we thought, he's a philanthropist in a way. He's a utilitarian. I can't remember what it was like. He believed in only doing good, and that's why he wanted to raise $1 trillion. But how come the bad backlash? I'm wondering about Michael Lewis's book. Does everybody think he gave SBF a pass? Was he too nice to SBF? Did they live together for a while?
Well, first of all, Lewis gets embedded with FTX, which is what he does with all his subjects. I asked him this, hey, did you get too close to them? He's like, no, this is the same process I did with The Big Short, with Moneyball, with The Undoing Project. I live with these people as much as I can to really have a fly-on-the-wall perspective. And the great innovation that FTX came up with, when you look at all these crypto exchanges, they essentially socialize losses. In other words, everybody puts their money into these exchanges. Typically, they're buying futures. They're not buying Bitcoin. They're buying futures on coins. And so
Barry,
when someone
Barry, we're just going to have to leave it here just because we're coming up against a stop, but we'll get you back next time to get some more on this because, again, it's a fascinating podcast with Michael Lewis. You can get that wherever you get your podcast for Barry. That's Barry Ritholtz, founder of Ritholtz Wealth Management and host of Masters in Business. We're going to have more coming up. This Let's go to Charlie Pellet right now with some company news.
Hi, thank you very much. And here's what's going on. Rivian Automotive shares plunging 19%. The electric vehicle maker announced plans to issue $1.5 billion in convertible debt and reported preliminary third quarter revenue. The bond issuance could dilute the current shareholders' interest. Rivian says it expects revenue for the 3 months ending September 30th in a range of $1.29 billion to $1.33 billion, compared with a $1.3 billion average estimate from analysts surveyed by Bloomberg. Rivian shares, again, they are plunging now by roughly 19%. The strike by the UAW drags on, now in its 21st day. Kevin Tynan is following the story for Bloomberg News.
From my view, I think what you're going to get is a big number for the UAW, but not a whole lot else. And I think that's probably what the issues are. The automakers can't hide their profitability over the past 10 years, and this mix shift to truck from car has been very profitable for them, and everybody sees it, right? But at the same time, they've done that with fewer units.
And that's Bloomberg's Kevin Tynan reporting. Ford shares down 1.5%, GM down 1.7%, Stellantis shares, they're up by just about 0.1%. ExxonMobil likely got a $2.1 billion boost to earnings from higher oil prices and refining margins in the third quarter, partially offset by a decline in chemicals profitability. I'm Charlie Pellet, and those are some of our top company stories, and this is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All righty. Paul Sweeney, Matt Miller. We are live here in the Bloomberg Interactive Brokers studio. Look at the S&P 500 off about 0.6%. The Dow off about 0.4%. NASDAQ off about 0.7%. Here, take a little bit of sell-off here in the marketplace. WTI crude oil continues its slide off almost 2% here, $82.59 here. Yields kind of a little bit softer here. 10-year Treasury, 4.71%. With our news, let's do a little billboard. Let's do a little work here. We're live at the Bloomberg Sustainable Business Summit, brought to you by Ecolab Water for Climate. When businesses reduce water use or increase efficiency, they can save energy while reducing emissions and costs. More at ecolab.com/water for climate. Coming up right now, we'll get world and national news, and we're going to do that with,
I don't know. Pick somebody.
Charlie Pellet?
Yeah, let's do that.
Wrong.
Michael Barr in New York City.
How are we supposed to know?
Oh, my. Thank you very much, Paul and Matt. Discussions continue within the Republican Party today over who should take up the mantle of Speaker of the House following Kevin McCarthy's controversial ousting this week. One name in play is Representative Jim Jordan. The Ohio Republican tells reporters while he doesn't support McCarthy's removal, he does say this is a chance to be able to unite the fractured party under a new speaker.
I disagree with what took place, but those guys are friends of mine, and I think that's the message I've been talking to my colleagues about is who can bring the eight into the part of the team, who can unite our team.
Meanwhile, moderate House Republicans are calling for the expulsion of Representative Matt Gaetz from the House GOP conference and punishment for the other 7 Republicans who voted to remove McCarthy. Louisiana Republican Congressman Garrett Graves had harsh words for Gaetz.
There were 8 so-called Republicans that got together with 208 Democrats to oust the Republican speaker. I mean, I can't believe he's that stupid to be used to being manipulated by AOC and others to create this outcome.
Meanwhile, Congressman Steve Scalise also announced he wants to be Speaker. Ukrainian officials now say at least 50 people have been killed in a Russian missile strike against a village in the Kharkiv region of northeastern Ukraine. On social media, Ukrainian President Volodymyr Zelensky accused Russia of genocidal aggression. It comes as Vladimir Putin says Russia successfully tested a nuclear-powered missile. The Biden administration announced it waived 26 federal laws in South Texas to allow border wall construction. It marks the administration's first use of a sweeping executive power employed often during the Trump presidency. Cornel West has announced that he will seek to be president of the United States as an independent candidate. West, speaking with the Wall Street Journal, decided to forego a run with the Green Party. West also slammed President Biden and former President Trump, saying the left is ineffective at preventing a GOP tilt to authoritarianism. Global news, 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Michael Barr. This is Bloomberg. Back to the great Paul and Matt.
Oh, thank you very much, Michael Barr. Matt, a listener/viewer writes in and says, where is Matt Miller's car? Literally, where is it physically?
The Scat Pack.
The Scat Pack. The Challenger, the Dodge Challenger.
I believe it's in Bay Ridge. And
why is it there?
I'm not so familiar with Brooklyn, but all I know is when I went out to this dealership to order it, it took a long time to get there, and I needed my navigation. So basically, when these cars were offered, this is the last year you can get them. So each dealer only had allocations for 1 or 2 or 3 units. And every dealership I looked at that had an allocation said, yeah, we'll give you one, but we're going to charge you $10,000 over ADM.
Right.
Over MSRP. And I didn't want to pay that. So I had to scour the horsepower locator, which is what Dodge called its database, and finally find this one dealer that would give it to me at MSRP out in the middle of nowhere.
Okay.
So that's why it's in Bay Ridge.
Okay. All right. We're going to stay on top of this thing until this thing is in your driveway. More coming up. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
We got a lot of green on the screen here, but the volume is light.
We constantly underestimate the strength of the U.S. consumer.
This is a market that's much more optimistic or bullish than maybe the central bankers are.
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
The supply chain has still got dislocations globally and here in the U.S.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, coming up in this hour, lots of stuff coming on. Lisa Abramowitz is sitting down with San Francisco Fed President Mary Daly at the Economic Club of New York. That's coming up in just moments. We will bring that to you. That should be very interesting. Plus, we're also going to talk real estate here. We do that with Selma Hepp, Chief Economist at CoreLogic. Talk about the housing market. We got interest rates, mortgage rates like 7.7%. What do you do with that? So we'll get that latest there. But right now, let's kick things off with Mr. Charlie Pellet.
Hi, thank you very much, Paul Sweeney. The Dow, the S&P, NASDAQ, they're all in the red. You were talking about crude oil, the sell-off there just a couple of minutes ago. Right now, West Texas Intermediate crude, yes, an 82 handle on WTI at 82.55, down 2%. Brent, the global benchmark, also down 2%, 84.11. Oil stocks are selling off as well today, along with the price of crude moving lower. Case in point, ExxonMobil, it is down now by just about 2.2%. BP, its ADRs, they're flat on the day. And actually, shares of Chevron, they are now higher by about 0.4%. Bottom line here, oil is extending its slump on concerns that slowing global growth will erode consumption a day after the market posted its biggest decline in more than a year. Brevin Howard, meanwhile, plans a $750 million push into commodities trading. Stocks lower, traders are fretting as to whether the labor market remains too hot for the Fed to head off another rate increase next month. Jobs report tomorrow morning, 8:30 a.m. Wall Street time. S&P down 28, down 0.7. The Dow down 0.5%. NASDAQ down 0.8%. 10-year yield 4.71% with a 2-year yielding 5.02%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate it. Matt Miller, Paul Sweeney live here at the Bloomberg Sustainable Business Summit. And it is brought to you by Ecolab Water for Climate. When businesses reduce water use or increase efficiency, they can save energy while reducing emissions and costs. More at ecolab.com/water for climate. As Charlie was just reporting, got some red on the screen here. Let's see where the action is under the hood with those equity markets. We welcome Bailey Lipschultz. He covers all the equity markets for Bloomberg News. Bailey, what are you looking at?
Yeah, looking at weakness in General Motors, ticker GM, Matt, down 2.4%. This coming after a Wall Street Journal article that says the automaker has at least 20 million vehicles built with potentially dangerous airbag part that the government says should be recalled. So a little bit of a knee-jerk reaction, but trading down near session lows, never good when you're recalling.
I mean, there's always these knee-jerk reactions with recalls, and the thing is, recalls happen constantly to all manufacturers and pretty much any vehicle that goes out there. So
how much of this is a person trading it versus a robot seeing a recall?
I'm going to go ahead and say in the long term, it doesn't matter that much. For the most part, when you see recalls, everybody kind of gets in a tizzy, which I love, sensationalism, alarmism, reactionaries. I love that. But at the end of the day, it usually doesn't matter that much.
And we saw initial drop-off in Novo Nordisk ADRs, ticker NVO, after that report that showed weight loss drugs, Ozempic and Wegovy, are linked to stomach issues.
Duh.
No, not a shocker there.
I mean, I think everyone knows, at least I have